Ladies and gents, welcome back to Chat with Traders podcast. I'm your host, Aaron Fifield, and on this episode, I invited Adam Grimes on for a second time. He was first on episode 21. You will hear me say episode 20 at the start of the interview, but it is actually episode 21. Just wanted to add that small correction in there. Adam's been a trader for more than 20 years. He's traded all major asset classes across various timeframes. He's traded independently, he's traded with a prop firm, and he's run other trading businesses also. The main focus of this episode was to explore some of the things which discretionary traders can adapt from quantitative traders and vice versa, meaning what things can quantitative traders take from traders who rely on discretion. We thought this would be interesting to discuss as Adam himself is someone who sits in the middle of both. Then, in the later part of this episode, Adam lays out a really solid framework for traders who are struggling to make progress, which they can follow and begin moving forward. Also, the types of questions you should ask when you don't know what you don't know. Now, just two things to mention real quick. I'm doing another Chat with Traders meetup taking place in Brisbane on the 19th of March. It's free, of course. For all the details and to RSVP, please go to chatwithtraders.com/Brisbane. Also, I asked Adam at the end of this episode if he'd be happy to answer any questions that you might have after listening to this episode. So if you would like to ask Adam a question, just go to chatwithtraders.com/115, scroll to the bottom of the page and type your question in the comments area. Thanks very much, guys. Hope you dig the episode. Here is Adam Grimes. Well, Adam, it's been almost 2 years since you were first on the podcast here. How have you been? What's been going on? Anything to report?
I can't believe it's been that long. But no, things have continued to develop. I'm doing, have several not work-related projects. I think it's important to kind of do some things outside of the markets because we get so tunnel vision. So I have some interesting personal projects. If you want to chat about those, we can. I'm writing a new book. Just began beginning of this year after massive planning, but I'm writing a book on the overlap between discretionary trading and systematic trading. And so, that's obviously going to be relevant to what we're doing here, but, no, pretty much business as usual. How have you been?
Yeah, I've been doing great. It's nice to hear that you've got a new book on the way. And that topic is obviously going to be the main focus for this episode. So I'm pretty excited about that. I think it's going to be really interesting and really beneficial for a lot of people listening too. For those who haven't heard our first interview, which I'm pretty sure was episode 20, just paint the picture a little bit. Give us a little bit of background on your trading background. You've been involved in markets for around about 20 years. So just give us a high-level overview of that time and some of the things you've done.
Yeah, sure. So I've been very fortunate in that I've done a lot. I've seen markets from a lot of different perspectives. It's more than 20 years. At some point, I guess I'm going to have to say it's almost 25 years, but been doing this 2 decades plus. And I started literally with no clue and no legitimate hope for success. I was trading very small accounts, massively over leveraged. I didn't even understand the concept of leverage and risk. And I was paying some insane, literally 15, 20 times what you'd pay for a commission today for a round turn. And there's no way I could have been successful. But, along the way and with some mentorship and guidance, I kind of figured out which way was up and which way was down, I guess. And I was day trading the British pound at the right time and made a little bit of money there, and then spent a few years, quite a few years actually, day trading the S&P 500 index. And across, I wanted to get a better education. So, I'd been educating myself on these quantitative concepts as best I could, but I went and did an MBA and did a good deal of PhD coursework with that to understand how people were looking at markets from a quantitative perspective. spent a few years on the New York Mercantile Exchange. I've traded for a prop firm in New York. Like I said, I've traded for my own account. I put together a commodity pool once I figured things out. And now I am a managing partner and chief investment officer for Waverly Advisors, where I write daily market research covering pretty much everything. I carry the lessons of active trading and my kind of very, I guess, agnostic maybe is the word, but I'm very reluctant to believe in anything, and I'm able to carry that from an active trading perspective into also to inform people who trade on much longer time frames. So, along the way, I've traded stocks, currencies, futures, options, all time frames, from very, very short term scalping to building portfolios for quarters and years. So I've kind of been around the block a few times.
And I'm not going to ask you too many more questions about that because we covered a lot of this sort of thing on the first episode. So if anyone wants more context around Adam's background, I suggest go back and listen to episode 20. That'll just be chatwithtraders.com/20. So the way you're trading these days, Adam, how would you best describe this?
So I would best describe it. First of all, it hasn't changed in 10 plus years significantly. I think most people would say it's a technical perspective. And it's technical in that I look at only price. I don't look at economics, economic releases, don't look at fundamentals, try not to consider, let's say, macro and political factors. And I'll say try not to, but the other piece of this is that my approach is a blend of heavy quantitative and statistical work with discretionary. So as soon as I tell you I'm introducing a discretionary input, somebody who is strictly quantitative might say, well, then you don't really fully understand what inputs you're bringing in, which, I can't disagree with that. But I believe that my process is very technical, very focused on price action. My trading approach and style is very simple. And that's taken many, many years to get to that point. Of course, I started with, if I look at some of my old charts, I had multiple indicators. I was drawing all these levels and trend lines and just really marking the charts up because I thought that's how you learn. You put more stuff on and more things that might have an edge. But over time, I've evolved to a style that really is based on just looking to understand momentum. And one of the faces of momentum is volatility, or perhaps I have that backwards, but understanding how volatility evolves and basically answering the question of, so a market makes a big move, what do we do? Do we position for another big move in that same direction? Do we look for a reversal? Or in fact, is there no edge? Do we do nothing? That's kind of the core of the technical trading question right there. And that's all I try to do with my trading.
Okay, very good. Now, this is going to be the main focus of the episode. We had a brief chat beforehand, and we're going to be talking about how you trade. Obviously, you're quite unique in the sense that you kind of sit in the middle of being a discretionary trader and being a quantitative trader. So usually traders are either one side or the other, but you kind of sit in the middle. So, let me just ask this question. Why do you sit in the middle? Like, why are you a hybrid of both sides?
Because that's where I have found the best edge. And that's where I believe over many timeframes, objectively, there is the best edge. Certainly, I think if you're a very high frequency trader, then you're operating at a speed where the human can't really compete. So you certainly can make a case for being purely systematic there. But there is power in human discretion. There is legitimacy, I guess might be the word, in human intuition, in this kind of implicit processing and learning that basically with assuming that you, and this is a major assumption, that you can trade with discipline and emotional control. A human acting with some discretion can generally outperform a system.
Okay, so you said that for you, you've found that that's where the best edge is. Before we go any further, I should probably just get you to clarify or just explain how you think about an edge. Like, when you talk about an edge, what does that mean? I know I asked you this first time you came on as well, but I think it's really important that we just kind of make things clear.
It is really important. And now somebody can go and put these two sound bites side by side and see if I say the same thing. I hope I do. So, I would say the simplest way to understand an edge is we're going to do a lot of trades. And that's key, that we're talking over a large sample size. And by the way, I try to put things in what I hope is a simplistic and intuitive framework. So, rather than saying law of large numbers, I'll talk about doing a lot of trades. I'm not trying to talk down to anybody. I just think that this is the best way to understand some of these concepts, is to make it as natural as we can. And if you imagine from those many trades, you're going to make two piles of money. You're going to make the pile of money you win and the pile of money you lose, because there aren't many things I can tell you with absolute certainty about trading, but one of those things is you're going to have losing trades. You absolutely are going to have losing trades. And if we are trading with an edge, then over the course of many, many trades, that pile of money that we make is bigger than the pile of money that we lose. So that's what an edge looks like in practice. Now, if we want to drill down a little bit more mathematically, I would say that when we identify an edge in the market, and we can qualify this, we have to be very careful, because there are a lot of different ways this can look, or different things we could do. But it basically means that there's a higher probability of something happening than something else. If we don't know that, so imagine there is no edge. Imagine that the academics who tell us that the markets just move randomly are correct. If those people are right, then there is nothing we can do that's going to make our results anything other than random. Of course, we're going to pay commission, so there are going to be frictions and financing costs. But if we don't have any edge, then those two piles of money at the end of the day are basically going to be the same, more or less the same. So what we're hoping to do is to be able to find a spot where there is a tilt in the probabilities in the future of one thing happening over another. Now, what is one thing over another? Naively, I might say the market might go up, or, with a higher probability than it would go down. But in reality, it's a little bit fuzzier, because the market, or it's a little bit more specific, because the market needs to go up over a certain time period. We might see one edge if we look out, let's just say 2 to 3 days, another a month, another 6 months. We might see that the edge or lack of edge is different at those different horizons. In fact, we probably would. An edge could also be volatility. It's very easy to get stuck in the mode where I'm looking for a directional edge, but there certainly are non-directional edges. There are points that tell us when this happens, volatility is likely to be higher or lower over some time window in the future. But the key is that we're just able to identify something in the market that says over a specific period of time in the future, the probabilities are likely to be shifted from 50-50.
So let's drill down into this further. Now we've sort of established exactly what you're referring to when you talk about an edge. What can discretionary traders adapt from quantitative or systematic traders?
Well, so this is the thing, when we had our previous chat and we were talking about how unusual it was to do a blend of quantitative and discretionary trading, I think I came around to, well, in reality, that's what everybody is doing anyway. You have the hardcore system people who think we're exercising no discretion at all. Well, that's not true, because you are exercising discretion at every step. What are you researching, or are using a genetic algorithm, and you've specifically decided you're not going to be feeding it things. You're going to let it find things. How do you determine if the system is, quote, good enough? How do you determine when to turn the box on, when to turn it off, what size to trade, when something might be changing and you need to take it out of the market? There are these discretionary decisions that go into purely systematic trading. To answer your question more directly, nobody seriously trades from let me figure out how to say this. Every discretionary trader thinks they are doing something that has an edge. You may not be doing statistical research. You may not be able to point to thousands of examples in the past, but you believe when you see this condition set up, you believe that this is more likely to happen in the future. Or, perhaps you believe, maybe you think you figured out something that the market is missing, but that's still, you think you have identified a tilt in the probabilities. And what happens with a discretionary trader, an experienced discretionary trader, is eventually you get some sense of what works and what doesn't. And that some sense can be your P&L, can tell you very clearly, when I did this, I was losing a lot of money. When I stopped doing that, I lost less money. So, you've learned something about the market. And the traders who stay in the market long enough from a purely discretionary standpoint, is an awkward way to say it, but the purely discretionary traders who stay in the market long enough, they eventually do their quantitative statistical work through their own trading. That's what it means to evolve a trading style. Now, if you don't want to just go through the school of hard knocks, or you don't have the capital to do it, or you don't have the decades to do it, or, for whatever reason, if you're looking for, quote, a smarter way or another way, well, then you can do research. And you don't have to learn that thing that I do, so every day a stock goes up 5%. That's my system. I run in and I buy it the next day, and gosh, I lose a lot of money on that. Well, you could discover that through research too, right? You could do a little bit of quantitative research and see, okay, so I was actually trading against the probabilities there. You also, the other thing is a question of mindset. A lot of discretionary traders, I think we all have had the discussions with people in bars who are telling you how smart they are and how they figured this out. And they just bought a boatload of, horrendously out of the money options on something because they figured something, they think they've solved the puzzle. And it's a lot about, this certain arrogance, and we're all guilty of it, but this certain analytical arrogance. And I think another powerful message a discretionary trader can take from the quantitative realm is this idea of scientific method, or at least, if not scientific method, then at least scientific approach or framework. And what I mean by that is that we ask questions of the market, we come up with ideas, and then we go to the data. So it seems like a pretty simple process, right? You say, does this happen? And then how do you answer it? Well, you can just go to the data and look and find the patterns. And that idea of tying your trading to the underlying, I would say the underlying truths, if you want to get philosophical, but the way the market moves, that idea is powerful and applies to everybody, no matter how you're trading.
Okay, so let's pick up on that last point you made there. So you said, you kind of described it, I think, as a scientific framework. So you said there's questions, you go to the data, and you find your answers. How can a discretionary trader do this sort of thing, where they ask questions and then they go to the data for those answers? Usually to get those answers, you need some sort of programming capabilities. I presume that most discretionary traders are not really interested in learning how to program. So how can they do this? Like, is there a workaround? Is there some other solution?
Yeah. So just before I answer that question, just the idea of understanding that this is what we are going to do. This is a significant shift, with a lot of the traders I work with one-on-one, just the idea of saying, okay, we're going to go to the data and we're going to see what the data says. One of my professors I did a lot of my coursework with had a very gentle way of saying, we would talk through concepts, financial concepts, what we thought would happen in the market. And then he would say, let's ask the data. So having that framework, that mindset, that's what we're doing. We're going to ask the data. That alone is a powerful shift of perspective. Now, how do you do that? Well, So I think hidden in your question is a misconception that I had when I started doing this work. I thought, and I think a lot of people share this misconception, this idea that quantitative analysis is so deep, is so complicated and so confusing that it's something that, gosh, I couldn't possibly do this because I'm not smart enough. I don't have the time. I don't have the desire to, whatever. We can keep listing reasons. That's what a lot of people think. But in reality, all you are doing is coming up with a set of conditions and then going back and seeing what has happened historically. And, granted, I'm simplifying a little bit here, but I would also argue at its core, the discipline is quite simple. That's what we're doing. You could do this with nothing more. First of all, there's a lot of free data out there. So you could do this with nothing more than a free data chart and a pad of paper. Just, let's say your idea is I want to buy, what happens if I buy stocks after they go up 3 days in a row? So you could potentially go back and open a completely free chart, and you could just very carefully visually look and see, okay, 3 days up, and then you could record the price, and you could record the price, I don't know, 5 days later, something like that. You obviously you need to figure out how exactly you're going to ask the question, but the point is to do this analysis at the beginning requires nothing more advanced than access to data and a pencil and paper. Now, what's the problem with that? It's slow and cumbersome and prone to mistakes. You certainly may see something that looks like 3 days up. You may miss it. So there are a lot of things that we can do wrong when we're doing this kind of intuitive's not the word. We're doing this kind of manual work, which, by the way, I think is important to do this manual work. Even if you are a heavily quantitative character, it still makes sense to spend a little bit of time getting your hands dirty in the data and just seeing, manipulating, touching the data on a very elemental level. So what's the next step for the discretionary trader? Well, the next step is Microsoft Excel or some other spreadsheet program where, honestly, I think my mother, whose computer skill is pretty much equal to Gmail and Facebook, I could probably teach her in a week to do basic market analysis in Excel. Like, anybody can learn to do it. If you have the passion and the desire to learn to do it, you can spend a few hours, and once you figure out how to Google the questions you have, you can get data in a spreadsheet, and you could even then just work manually in that spreadsheet. You could, you create, how it works. You create some formulas, but you don't have to write a big framework in C++ or Python and pull in hundreds of thousands of data points of tick data. You could do this very nicely with a daily chart and a relatively simple spreadsheet program. So to the people who are kind of thinking, oh gosh, I could never do this, I would counter, you absolutely can do it. It's not nearly as hard as you think it might be.
Okay. Now, I think a good question for me to ask at this point is, for someone very new to this sort of way of approaching things, what might be some good questions to ask? Like you gave there the example of, 3 days up in a row, what happens after that? What are maybe some other things that people could experiment with? Because, a lot of discretionary traders are trading like chart patterns, for example. So they might be trading double tops or that sort of thing. That thing's quite difficult to sort of quantify in many ways.
Yes.
So
yeah.
What are some other good questions that they could ask, and how do they sort of deal with that issue that some of the things that they do trade are a little bit difficult to actually quantify, like write down on paper?
Well, so now we're going a little bit deeper. Now we're going to the next level, and here we touch the real problem with we're talking about some kind of back testing. The real problem with any kind of back testing is that we don't need to just understand what pattern has been there in the past. That's relatively easy to do. The question is it reproducible in the future, and is it likely to persist in the future? And that's I think a lot of people get stuck with market statistics, like, the people that just spew tons of market statistics. Of course, you can calculate anything, but the real question is this likely to be meaningful? Is it something that's likely to say something about the market in the future? So why that little diversion? Well, for instance, you could have, there's no reason why you could not test your complicated chart pattern. And, I'll come back around. I don't think this is a great idea, but you could test your complicated chart pattern just by looking at charts historically. And a lot of people do this. You could, let's just say Head and Shoulders, since everybody else in the world loves that. You could say what happens after a Head and Shoulders pattern, and you could apply this sort of scientific approach. And as you said, you need to define the pattern somehow. You need to say, okay, this is a Head and Shoulders, this is not. And if you think you just have the skill of picking it out on the chart, let's live with that for now. And then I'm going to make it a little bit more difficult in a moment. But if you think you can identify the chart in the past, then you can structure the question. Okay, so what happens 1 week, 1 month? Again, I don't know exactly how you want to ask the question, but what happens after the Head and Shoulders pattern occurs? And then you could answer that again with our piece of paper or spreadsheet. Now, of course, with the pattern recognition, the problem is that what we can identify in the middle of the chart is very different than what we can identify at the right edge. We can easily see patterns in the middle that we can't really see forming in real time. So how do we challenge the person who thinks he can identify a Head and Shoulders pattern reliably? The answer is to take some kind of system, and there are many, many systems that will do this, where you can page through one bar at a time, or even have, many platforms will play the market back as the action forms. And then you can do the same thing. So you're exercising discretionary pattern recognition and pattern reading, but you're no longer doing it in the middle of the chart, which is so artificial. You're now doing it one bar at a time. And just, to be clear, the way I would do this is you'd watch your market and you say, oh, here's my Head and Shoulders on this bar. Because you have to have a point where you're going to execute. So it can't be fuzzy, maybe, maybe not. You have to have a point where you say, okay, I would do this trade on this bar, and then you track what happens. I would also be a little bit careful. You probably don't want to, as soon as I say that, you probably will tend to go into a system trading. Okay, so I would buy here, my stop would be here, my target, if I have one, is here. Once the trade develops, I'm going to move the stop like this, or I'm not going to move the stop. Here's the size I'm going to add if it goes down here. There are all of these other questions. And as soon as I start talking about these questions, if you were mapping out the possibilities, you see this just blossomed into some very complicated, convoluted branch. Like now I'm no longer asking the simple question, what happens after my Head and Shoulders pattern, which is not such a simple question, but now I've added all of these other things and assumptions. And if we change one of those assumptions, my stop is here instead of here, then we get a different answer. So you create thousands of possible answers. I would not do that. I would focus, when you're trying to understand the market movement, just very simply on what the market does. So, just looking at returns, which the word return just means a percent change. Sometimes people are like, oh, when you talk about market returns, what does it mean? It's just a fancy way to say percent change, how much the market moves. But you would be looking at returns over different time horizons, just so you understand how the pattern moves. And the person who you need a fairly large sample size, this type of work, well, let's just say it like it is. It's kind of, if you're a numbers nerd like I am, it's fun to do this for a while, but it does get tedious. It gets difficult. It sucks because you're just looking at a lot of patterns and writing down a lot of numbers. It takes a lot of time, but you want to trade, right? And we know trading isn't easy, and you don't expect, I hope, to just go buy some $499 system and have all of the answers. It doesn't work like that. It can't work like that. So this is one way. It's certainly not the only way, but it's one way you could start to understand and learn how the market moves. And so the person who first identifies the Head and Shoulders patterns in the middle of the market should then do the same thing at the right edge. And ideally, she would do this with a different data set. It's I don't want you really pulling these patterns out of the middle and then just playing the same data back one bar at a time, because you've learned basically, and you're, whether you realize it or not, you're going to remember and you're going to make some decisions. So it should be a clean data set. This is not even really possible, but that's quite a deep quantitative question, but because things are so tightly correlated in so many ways. But ideally, what I would like to see, if we can deal with these issues, is that the data set where you pick them out at the right edge looks something like when you pick them out in the middle, and both of those show a similar edge. That would be verification to me that from a subjective standpoint, you can identify the patterns. We're not ready to trade yet. Then we need to work on bridging this gap into actual trading, probably with some forward testing, some very small trading. And then we're off to the races. But that's one way to do it. Now, as I said, I think that approach has a lot of moving parts. I think, identifying the pattern is not trivial. So perhaps you're right, the beginning trader does not know what questions to ask. And I would start by asking questions that, as you do this, don't be afraid of asking stupid questions, because as you learn, we hope you're going to be able to look back a few weeks, a few months, certainly a few years from now, and there's an Einstein quote, right, that he would say, to paraphrase, he says something like, his best hope for the future of humanity is that humanity would look back on people in the middle of the 20th century with pity. With a gentle pity. And that's meaning, of course, the people have progressed past so many things we struggle with. Hope that's your hope as a trader, that you look back at yourself today from the vantage point of the future, and you I was asking such cute and wrong-headed questions because I've learned more of the right kinds of questions to ask. So at the beginning, it's just a matter of understanding the methodology. You can ask something like, is there any edge to trade to buying today if the close is above yesterday's high? You can look at very simple relationships of bars. We have an entirely other layer of information. There are all these indicators and moving averages and things that we can start to add. And, people can do a lot of things around there, but I probably would start with price in a more, at least at the beginning, with a more pure view on price. Because if you just start trading or you start analyzing, say, an RSI or something without really understanding what it might be telling you about price, I think you're probably missing a few steps. So short answer is, you can ask whatever questions you want. Start with very simple questions, and the answers to your questions will probably provoke new questions. Also, let me amend one of my previous answers. You asked what could discretionary traders learn from quantitative traders? Well, most quantitative systems fall in a fairly small area. But basically there are things that people do pretty consistently, and they do it in different ways, whether they're trading mean reversion or momentum, whether they're trading on different time frames. So the discretionary trader could, if he was interested, could read some of the quantitative books and research, and he can skip over the code and the more mathy parts, if you will. I don't think I've ever said that word. the more mathy parts, and can just look to understand what. So when they're doing this mean reverting system, what element are they queuing into? And so what does this quantitative approach say about the truth of how price moves? So I think it's also possible that a discretionary trader may get some ideas for the right questions to ask from looking at other people's work and reading some other research.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I happened to $1,000 in buy data, master?
Like what sort of answers you're actually looking for. So we've discussed quite heavily what sort of questions might be good questions to ask in the initial stages. When you're asking these questions, what are the answers that you're actually hoping to get for? Like when you write down on paper, you said there, the returns. When you talk about returns, there's obviously some time factor involved as well. So what sort of things, after you ask these questions, should you have written down on your paper or typed up on your computer, or however you're doing this analysis? But what do those answers actually look like? Does that make sense?
It does. No, it does make sense. And I know because of the work that you've done, I know that you're actually hiding a very deep question. And you're hiding a very deep question here. So the answer depends on what time frame and what type of question you're asking. If we are, let's take the simplest example. If we're looking at, say, a very short-term intraday system, then really we just kind of hope that the market goes up after our long signals and goes down after our sell signals. And we do need to make sure that we look at enough different market environments. It would be naive if let's say I create a day trading system and I happen to test it over 2 weeks of data, which is not nearly enough. And I tested on 2 weeks in which the market just went up, up, up every day abnormally. And I look at my results and I say, oh gosh, look how good the buy signals do here. Sell signals don't work so well. So I found a good buy signal. I'm just going to trade that. I'm done. Well, that's not going to work. You know that. So, what we need to do is to somehow adjust for the baseline, what I would call the baseline, which basically is what happens if we don't do anything to the market. And maybe the easiest way to understand this is to leave the day trading realm and go to, let's say, a longer term technical system for stocks. So let's say you develop a system, just keep it simple, where you buy stocks and based on some set of criteria, and this is a rule set that we can test, and our exit is we're just getting out 1 year later. So if we run this system, let's say you run this system and you come to me and say, Adam, I'm so excited. I found the system and it makes me 5% a year. And I was okay, great. So now let me ask you another question. What would happen if you just did buy and hold? And chances are you would go away with that data set and you'd come back and you'd say, well, crap. If I did buy and hold, I probably make 7 or 8% a year. And all of a sudden your system that made 5% a year doesn't look so good. So, the reason this is much more obvious at these longer term time horizons where, particularly in stocks over a long period of time, we have an upward drift. And the intuition here is that if I can make 7% with buy and hold, I just simply have to do 2 transactions to access that, in the most simple. And I pay no commissions outside of that. It takes also none of my time, none of my research. It's a very simple thing to do. So if I'm going to actively trade, then I need to be paid I deserve to be paid for my efforts, to be paid for my time and paid for my risk of being in and out of the market. And I'm going to be incurring frictions, transaction costs. And so I have to, if you came back and said, so the baseline drift, the buy and hold return is 7%. And here I found a system that makes on average 12% a year. Okay, now maybe we have something to talk about. By the way, interesting aside, it's very, very common in this situation that you might come to me and you might say, I found a valid sell signal that only loses 1% a year. meaning that if you were short the stocks, they only went up 1% when everything else went up 7%. And I'm using very made up round numbers here, but and this gets us into statistical significance. So there are two kinds of significance there, at least, right? There's statistical significance. And what this means, and there's no way really to answer this question without doing a little bit of math. And the math is, depending on your quantitative background, the math is either trivial or not completely intuitive. But the basic idea with significance testing is you want to look at the difference between two things, and you want to say, well, how likely is it that I just got lucky or that they're really different? In other words, another way to think about it is how big is the effect? And the effect would be let's go with our head and shoulders pattern, that, we think when we have the head and shoulders, it does this to the market. And if I just did buy and hold, I would have done this. So how big is the difference between those two sets, and how variable, how much noise, I try to avoid using words like standard deviation, but how much variability is there in the data? So how likely is it that there's an actual difference? There are ways that's a pretty complicated question, but there are well-established ways that, again, anybody with high school math and the desire to learn can absolutely learn that. And many of you had this in school. So as I said, it's trivial. However, there's still the question of economic significance. It is very possible to find things that short situation, where I've seen many, many short signals, which are statistically significant, but they still lose money because you would have been short in a rising market. Your rising market would have just, on average, a rising market. Your stocks would have gone up a lot less than the baseline, but they still would have gone up, meaning if you were short, you would have lost money. That is statistically significant, but it's obviously not something we're probably interested in trading as an outright. Perhaps there could be reasons we might be interested in trading it on relative value. It could have some attractive volatility. There could be reasons we would look at it, but as a standalone, that's not an attractive system. It's a losing system. There are also day traders like one of the famous problems of day traders is it's very easy to find systems that do have an edge, but the edge does not cover your transaction costs, or it doesn't cover your transaction costs with any leeway. So, you potentially can trade something like that, but it's just a very, very thin tightrope. Also, as an aside, be careful if you're doing day trading systems that you're accounting for the bid-ask spread, because a lot of things that look like edges are really just bounces between the bid and ask, and there's something you could not execute at all. So that's, if what I just said went completely over your head, don't worry about it. But if you are doing day trading research, that's certainly something to be very aware of.
Now, Adam, I might be jumping around a little bit here, but I think we both know that there are some discretionary traders that the strategies that they trade, if we were to do some various forms of quantitative analysis on their actual strategies, they wouldn't actually hold up. Yet those traders do still tend to make money. Is that problematic in any way? I mean, the way I interpret that is that the edge really lies within the trader.
Well, I mean, it depends what you're trying to do. And I would argue the edge does lie within the trader. I think that's legitimate. I think you are correct. And I think there certainly are traders who trade very, very well like that. I think anybody trading, with a discretionary input, you are part of the edge. So what are the drawbacks? Well, one of the drawbacks is, and this is something that's happened traditionally, there have been many, many successful traders who cannot teach, and many, many successful traders who they don't understand why they make money. Let me give you a completely absurd example. But there were traders back in the days of the pit. There were traders who had lucky ties. And they wore these ties for years and years, even after they shredded and started falling apart. So just wearing some little stub of a tie, and it becomes this superstitious thing. Now, the guy probably knows, if you really sat down and had a heart to heart, he probably knows that his his trading prowess is not tied to the magic tie. But you can just take that a few steps, and you can see there are people who are using things that don't have an edge, that yet they can make money, but they don't understand why they make money. So they think it's because of the magic moving average or the magic indicator or the magic news, whatever, Squawk Box, whatever they're listening to. And they have some skill that they don't understand. This is impossible. And by the way, you see the same thing. Trading is not unique. You see the same thing in music. I was a professional musician before I was a trader. We didn't talk about that background, but you certainly see many musicians who can't teach simply because they don't understand how they do or why they do it, why they're able to do what they do. So they might teach in all sincerity. They might really care. They might be the most engaged teacher in the world, but if they don't have the tools to truly understand how they do what they do, they can't teach it, they can't transmit it. And that certainly has been an issue with trading. One of the other issues, you just asked me a broad question, is it problematic? It's problematic because if you are part of your edge, then anything that happens to you can affect the edge. Some of the traditional things, if a trader runs into financial trouble, let's say a real estate problem or a tax problem or an illness in the family, or they're going through a divorce, traders will typically lose money through those times. And the reason perhaps is because their emotional element, their emotional makeup is so compromised that they're not able to apply this powerful discretionary analysis that they've learned to do over the years. And so they lose their ability to read the market. If you are part of your edge, then perhaps your edge is a little bit more vulnerable. Now, this is one of the arguments for trading in a more systematic approach, but I think it's important to be aware that this is a potential problem, but it does not necessarily invalidate the discretionary approach. It's just something to be aware of. Let's
switch tables now. The question I asked you earlier, what can discretionary traders adapt from quantitative traders? I think we've spent a bit of time on this. Let's turn things around. So what, in your opinion, can quantitative traders or systematic traders, call them what you will, adapt from discretionary traders?
Well, it depends on what kind of quantitative trader you are. There certainly are quantitative traders who trade the types of systems that should remain purely, whatever word you want to apply, algorithmic, I guess, purely rules-based, and they exercise no discretion in the execution. Those traders certainly exist. I would, however, say that some of those traders probably should be a little bit more open to I hesitate to use the word creative, but let's go ahead and use the word creative, to the creative aspect of doing research. Because as a quantitative trader, you're going to need to generate and refine ideas. And as you monitor your system performance, you're going to find the edges come and go and things will need to be tweaked. I shouldn't say absolutely, but almost certainly you're going to find this. And so I think being open to some of the quantitative people I have known have been quantitative to, let's say, almost to a fault. They're very rigid. They think there's only a, very numerical way to see things. And I think some of these people could probably open themselves to insight. Maybe that's the phrase. And what does that look like? Well, as a former composer of music, I can talk a lot about creativity and how you take ideas and turn ideas and look at ideas in different ways. But, I think at least that person should try to find some new ways to look at the data. And it could literally be as simple as, if you normally sit at your desk, then, take a printout out and go for a walk and be careful crossing the street, but just somehow shift your work environment enough that you look at things differently. Have some specific brainstorming sessions. Be very, very, very sensitive to the message of subconscious intuition. If you find yourself dreaming about something or thinking about something or obsessing about some small element, go into it deeper. Perhaps consider, I'm a big believer in doing different kinds of meditation and breath work and things like that. There certainly is plenty of room for that, different ways to open yourself to different kinds of intuition and insight. And I think if nothing else, the very strict, and not to pick on engineers, but a lot of these people come from engineering backgrounds. A lot of these people, in my experience, could benefit from a different perspective. And I mean that in the most literal sense, just looking at the data a different way from a different angle, just a different perspective.
Right. And I'm not sure how to best ask this question, but I feel as though discretionary trading probably plays a lot more on human behavior in markets, more so than quantitative trading. Maybe that's not a fair comment to make, but I think you kind of know where I'm going with this. Like, how do you factor in human behavior into quantitative analysis?
Well, you personally have done some system development, I know, and I would argue the patterns the market generates are always, you've done it already, whether you realize it or not. The patterns you have analyzed are shaped by human behavior because this is what moves prices. The reality is we might wish we lived in a sterile academic white lab coat environment where, consider the efficient market perspective. The market generates data, data is generated. It comes into the market. It's immediately and correctly processed, and people immediately make the correct decisions and execute those decisions with no time lag. The world doesn't work like that, and we know that. So what is far more likely to happen is that every decision made in the market, because we're human, includes both an element of analysis and an element of emotion. And there are times when these play, there are times when I would say markets are very rational. There are times when I would say markets are very emotional. And if you have identified a pattern, because it's, as a quantitative trader, that's what you do. You identify a pattern, and then, you're very familiar with the process I outlined earlier, where you look to understand what happens after that pattern. That pattern and what happens after that pattern is shaped by human emotion. And then, so you might ask the question, the next step removed, well, what if everybody starts to trade more algorithmically? What if the market becomes more and more algorithmic? Well, those algorithms still encode human behavior in the rule set of the algorithm. So there's still human emotion and behavior, and there's still, in the limit, there's still people turning off boxes when things get really crazy, or there's still, when markets go outside parameters, the way things trade change. So there are, there are all of these elements baked in, and I would argue that it's always there, that any kind of trading is already accessing human behavior, focusing on human behavior.
Earlier, you made the comment that there's an argument that if you apply discretion to your quantitative research, that it kind of throws off the accuracy of that research. So, just in regard to your own trading, how do you deal with that?
Well, so one of the keys, I think, is you need to define very clearly what is discretionary and what is not. In other words, what is an appropriate realm for discretion and what is not. So position sizing for me is not discretionary. I can't say, I have a high confidence in this trade because, well, first of all, that would be illogical because I know at best I have a very small tilt. So there's no point where I can say I must be right about this. I don't really know. So I can't go in quadruple size on a trade because I think the chart pattern's really pretty. I can't do that. But there are, so for me, the discretionary element is within some you set quantitative parameters for, say stop placement. Stop could be here, could be here. I'll put it here based on subjective factors. And there's still the question, if my trading is pattern recognition based. So there's still the question of, is this a valid pattern? Should I enter here? And there certainly are points where, somebody can come back to me and say, I've had many, many people do this. Was this not the same pattern? Were you not looking at it? And, for whatever reason, as a discretionary input, I decided not to take the trade at that time. So, there's the question of, enter or not enter. And it can be because of, correlation with other markets or other types of risk. But it really is a matter. Being a discretionary trader does not mean you can just do whatever the hell you want. I think some people, from particularly from a quantitative background, who are suspicious of discretionary trading, that's what they think that we mean. You just do whatever you want. And I think people who approach discretionary trading like that probably don't trade very long, because the reality is you can't do whatever you want. The market will encourage you to do the wrong things at the wrong time. You make a pile of bad decisions and end up doing exactly the wrong thing at exactly the wrong time enough times, and you're out of business. So it really is a matter. And look, I think we just had an almost hour podcast where nobody said discipline. How often does that happen, right? I think this is the discipline word. That this is part of the discipline of discretionary trading, is being very clear on where and how you will use discretion. It's not a free for all.
I really like that answer. I really do like that answer. I think that was well said. This question might help, I think, to kind of bring this whole topic together. You mentioned to me when we had a call before this that you're about to start trading some markets and doing some things that you've not previously traded before. I think one of the things you mentioned was commodity spreads. So I'm just interested to know, how are you actually approaching this? Like, when you decide to trade a new market and explore something new, what's the starting point for you, and how do you kind of approach that whole process from like deciding this is something you're going to explore to actually getting to the point where you're actively trading it?
Well, I mean, so there are basic reasons, I would almost say financial reasons why some markets might be more attractive than others. For instance, beginning traders jumping into futures, it's a little bit difficult to deal with the leverage. You basically have to take a lot of risk on a single trade. Well, let's say swing trading futures. So you're holding for a few weeks. That might be a difficult way for a new trader to start, because you're going to be literally risking thousands of dollars on a trade. So there are economic realities that could tell us that some markets are more attractive than others. Of course, depending where you are in the world, you have easier or harder access to different markets. So some of these decisions are kind of made for us. There are also questions of trading style. And this is something that's a little bit hard to, not a little bit hard, it's extremely hard to know at first. Like everybody in the world wants to day trade, and they want to day trade currencies because of the leverage, or stock index futures. So everybody kind of wants to right away do the most difficult thing where there might not even be that much of an edge, and they think they're going to quadruple their money in a month because of what some website said they could do. And so, at the beginning, we all kind of start there, in some variation of that. Most of us do, with, I certainly did, with no clue whatsoever. But, there are things like more quantitative types tend to be drawn to options or bonds. The question of, if you have actual legitimate expertise in an area, like, I know people who trade medical and pharmaceutical stocks with medical backgrounds. That makes sense. There's also a false sense of this too sometimes. Like, I thought when I started trading, I grew up in a farm community. I have a pretty good idea of how things go into the ground, come out of the ground, what what eats what and what's used for what, and how you process these things. And I did a little bit more research, and then I thought I was really educated. And so I thought I had some special knowledge and skill in agricultural futures that turned out to not be true. And I think there are a lot of people who, for instance, may think they have some fantastic skill in trading stocks that are really active in the news. And it's like maybe they do, maybe they don't. But you can answer that question with with an objective look at your trading results. So people are drawn to markets for different reasons, some good, some bad. You do need to consider the practicalities of whether you should be trading a market. And then I think to some extent, I'm going to say something that is probably a meaningless statement, but in every market, there are a lot of things that are the same, and there are fewer things that are very, very different. And, we need to understand what is the same. Like if if things go up, things go down, things trade, you need to understand the kind of basic like entry level, when's my market open? When's it closed? How do I execute? What kind of account do I set up? So you certainly should have that kind of knowledge before you execute. But, then you need to know things like a stock trader sometimes is very surprised when he goes to trade options and he pulls up an option that is priced at 350 on his screen, and he sees that it's bid at 365, offered at 430. and he's like, oh, I've never seen that in a stock. And by the way, this thing hasn't traded in the past 10 minutes. And so it's understanding, what might be different, both from the mechanical standpoint like that, but also how does the thing move differently? And there are objective differences in different assets. For instance, on a daily time frame, stocks mean revert more than commodities. This is why you don't really hear people talk about trend following in stocks unless they're really stretching the concept. And by the way, generally not taking shorts. But people certainly do trend following commodities, and you can execute some type of trend following in currencies where if you see a lot of people who trade mean reversion in individual stocks, but you don't really do the same thing in currencies because the market, there's some difference in the way the market moves. And you figure this out when there are a lot of ways you can figure it out, but, hopefully you figure it out by doing some research to understand how the market moves. And then you craft your trading approach, and you go through this process of creating a trading system, back testing it, forward testing it, and then you start trading with a small size. It's, it's literally not rocket science. It's a fairly basic and repeatable template. But I do think another caution here is that many people develop skill in one market. And my experience has been every time I've gone into a new market, there's been an adjustment period. And, I hope you can hear when I say adjustment period, that's actually code for losing. So there's a period where you go into a new market and you are not going to take your skills from another market or another time frame necessarily and just start making money right away. You're going to go through a significant adjustment period. So you got to figure out how to structure your life and business so you can live through that without too much damage.
Just before we get off this topic, what we've been talking about for most of the episode this far, we've been talking about some of the things that quantitative and systematic traders can take from discretionary traders and vice versa. The goal is not to try and push a trader in one way or the other. It's just to talk about, some of the things which can be helpful across the board. So, is there anything which you would like to add to the things we've discussed already? Is there anything that you might like to add? If I missed a question that you think is important regarding this topic?
No, I think you've I think you've asked the right questions here. And, like if we were sitting in a bar, we could have a 12-hour conversation about these topics. But I think we hit the essential points. And, maybe kind of to recap that, it's hard to know what to say, right? Because you don't know who the audience is. Everybody listening is listening from a different perspective. But if you're listening to this thinking, I could never do this research stuff, I want to say to you very, very clearly, you can. It's not nearly as hard as you think. I mean, my formal education, I was a musician. I had, I think, one math course in college, and it was basically where we talked about how math concepts made us feel. I had no math, I had no training, and but because I had an interest in learning to do this, I actually developed some respectable quantitative skills, just because I had to have them. I knew that I needed this to understand the data, and you can do it too. We hear a lot about how trading is hard. There are a lot of ways to make trading harder, but I think that one of the ways to make it easier is to clearly lay out a plan of attack and what you need to know and what skills you need to develop. Because, maybe a topic for a future podcast is this isn't really about knowledge. We have knowledge, we have things that we know about markets or things we think we know, but then the skill of trading and the skill of applying these is not, it's extremely important. It's not just what you know. But if you don't have the knowledge, then it's hard to develop the skills because you don't know what you need to be doing in the first place. So, that's to the discretionary trader who thinks he can't do this, and to the quantitative trader who thinks that any discretionary stuff is just BS, to use a kind word for it. I would say I think you're probably wrong. I think you are cutting yourself off from a potentially powerful way of knowing. Yes, there are many cognitive biases. There are many mistakes. There are many emotional mistakes. If you think you have run to systematic trading because you did not have the emotional control to trade as a discretionary trader, God be with you. Good luck. That's probably not going to work. And this is something we hear from a lot of people, but you are going to have emotional control. You are going to have discipline, and having a systematic approach is not a substitute for that. It may make some things worse. It may make a lot of things better, but you are still going to face many of the emotional issues of trading, perhaps magnified, because guess what? Now you're one or two. The thing about the discretionary trader, I have control. I can go get out of my positions tomorrow. You have, it's one of the dark secrets of quantitative trading is you're a little bit out of control. Your control is 2 or 3 steps away. And sure, you could intervene and close everything, but you don't have, some people actually experience a magnifying of emotions with quantitative trading, which seems counterintuitive, but it's actually quite common. So just, if you are coming from a very rigid quantitative perspective, I would argue that an intuitive discretionary perspective is not completely different than your way of analyzing. It's just another perspective. It's another way to focus the, pretty profound cognitive power that's between your ears on the market problem.
Now, Adam, you're a member of the Chat with Traders Facebook group, and I posted in the group yesterday, I mentioned that I was going to be having you on the podcast again, and if anyone had any questions, I would try and squeeze them in if we had time. So I know we've run for over an hour already, but I think we've both got a bit of time. So I'm going to ask a couple questions that came from out of the group, and just for anyone listening, if you do want to join the group, of course, it's totally free. Just go to chatwithtraders.com/Facebook. That'll redirect you to the actual group page. You just hit the join button and I'll accept you. So pretty straightforward. One of the first questions that came through, and I thought this was quite a good question and very relevant to you considering how you trade. What are your thoughts on trading many asset classes versus just trading, let's say, equities only, just as an example? Because often traders, and some of the traders who have had on the podcast here, really advise against this, and they sort of tell you just to focus, or not tell you, they talk about how they do. What they do is they just focus on one asset class, and that's particularly advice given to beginner traders as well, less experienced traders. What are your thoughts on trading many asset classes versus just focusing on one?
I'm curious, are those traders who give that advice, are they generally day traders, or would you say it covers a range of timeframes?
Well, the one trader that comes to mind, probably because it was just recently, would probably be George, Rolly Trader. He was on episode, I think it was 110. So he's an equities trader. He trades in the Australian markets, but yeah, he's not a day trader as such. He's more of like a swing trader, I guess you could call him. And I don't mean to single him out. I'm just bringing that up. I just kind of threw the question out.
So I think from a day trading perspective, you could easily make the case. The answer to this question is it depends. So I'll put the answer up front. From a day trading perspective, you want to dig deeply into market. You want to get familiar with its quirks, with its time of day influences, with what happens with other markets, and how influences might flow back and forth. And to do that, to begin to develop, let's say you're an active day trader, you probably would need to spend, 6 months at least before you start to develop some real knowledge of a particular market. It is very, very difficult, depending on the type of day trader you are, to follow more than one market. So there certainly is a justification for specialization there. There also is a justification for specialization based on the information you use. For instance, if I were an equities trader who traded off of, let's just say earnings releases, or off of changes to language in earnings releases or SEC reports or something like that, obviously I have, and then say I'm that kind of trader and you drop me in commodities, I got nothing, because I have no information. Or, if I'm a commodity trader who trades on crop reports and then you put me in the currency market, I don't know what I'm looking at. I don't know what to do. So there are possibilities for having legitimate edges based on certain types of information that are asset class specific. Now, if neither of those things is true, if you don't need to focus on one, then you're not using specialized information. So let's say you're more of what we would call a typical technical trader. I think you still need to be aware. So, here is one of the lies, I think, of traditional technical analysis, is we are told you can apply the same systems, the same tools, the same chart patterns, the same indicators to any market or any time frame. Have you ever heard that? Of course, right? Yes. And, so I can tell you, I can show you then, I can create a very simple quantitative test. Let's just say buying a breakout of 20-day highs. And if we apply that in commodities, you would see buying 20-day highs, shorting 20-day lows would make you a little bit of money, all other things being equal. And then if we apply the same system in stocks, it would lose us money. So then I would say, I think what we've seen here from a very simple test is an expression of this idea that commodities tend to trend a little bit better. So if this is true, why would we expect that we could just apply something blindly without even knowing what's on the chart? Now, I think there's some truth. I don't think, the idea that you can cover up what's on the chart and cover up the price scale. So I don't know if we're looking at soybeans or wheat or whatever. I think you probably could make a lot of good trading decisions based on that. But I do find, at least personally, because I'm aware of the quantitative difference with the power of mean reversion, the balance of mean reversion and momentum, because that's how I think of it. From a quantitative perspective, you have these two forces, mean reversion and momentum, which typically tend to be in balance. When I'm telling you something that I believe, this is not something I know to be true, but I think when they're in balance, the price probably moves pretty randomly. I think this is why a lot of research projects that look at price movement say price random walks. When those forces are in balance, they do. When we're able to identify points where one force is likely to, this goes back to an edge, one force is likely to prevail in the future, then we will find that price movement is not so random. And because I'm aware that this balance of mean reversion and momentum is different in different markets, I will do types of trades. I think it's subtle, but I think it's real. I'll do types of trades in currencies or commodities that I would not do in stocks, and vice versa. Also in stocks, I am very aware that I may think I'm the smartest stock trader in the world. And by the way, I'm very aware that I'm not. But I might think that I do the best stock selection possible. But I know I can be long the 6 best stocks in the market. And if something happens that cracks the market tomorrow, I'm going to lose on anywhere from 4 to 6 of those. And, in fact, it's just so tightly correlated. And that's not really a concern that we have with most other things, but, we certainly need to be aware of concentrated currency exposure, or, if you have on a long trade in crude, RBOB and heat, you don't really have on 3 positions there, but, then you have one in natural gas, then, maybe you do have another position there. You need to understand the correlations and how things move together. So I think you need a level of understanding that goes beyond the simple chart pattern. Now, I don't mean to, I want to be very careful about this, because I think sometimes people talk about trading concepts like they're so complicated you could never learn this. And, like one of the things with the traders that I work with, we work on very simple concepts. And all of this stuff is like this insight that I've just talked about. I think somebody trading an asset class for a year or two will get a very good sense of this. And I think if you trade it and do the research, you can have a pretty good understanding. So, for me, there's a certain diversification. And I can point to many, many times when my stock trading has sucked, but I've made enough money in currency to make up for it. Another way to think about that is I had great trades in currencies and lost it all in stocks. But at the end of the day, even though you would think trading commodities, they're relatively uncorrelated as an asset class, you do see some kinds of wins and losses that come into phase with each other. And generally, not always, but generally speaking, if you're going between these asset classes, you may be able to smooth out your equity curve. So, the answer is it depends. That's my answer. But I think, is there room for somebody to specialize just trading one particular stock ticker? Absolutely. Is there room for somebody to just trade a single currency or just swing trade wheat or something? Absolutely. There are people who do that and do that well. So truly, it depends.
Okay. I think it is probably a fair suggestion for less experienced and traders who are very new to this to just kind of narrow their universe, though. Would you agree in that?
I think so. Narrow and simplify. Yes, especially, and thank you for pointing that out. I think it would be irresponsible to think you're going to trade everything all at once. But I think pick some place to focus on it a few years when you have a little bit of proficiency, which, honestly, depending where you are in the learning curve, that may not mean you're profitable. Let's be clear, the learning curve is usually several years. In fact, I've never seen it be significantly less. So once you develop some skill and then you want to investigate another asset class, I think that's fine. But what a lot of people do is they'll kind of be like the, like the bee that's bouncing from flower to flower to flower, and if you do that with trading systems and approaches, you never give yourself time. Not only you never give yourself time to really learn, but you also never give yourself time for all of these things. What's the first thing I said, I think, was that all of this stuff only works if we do a lot of trades, if we collect a lot of data. And if you develop a trading system and you go and you do 5 trades and you're not happy with the 5 trades and you trash it and move on to another trading system, that's probably not the way you're going to build a career. So you definitely need to spend enough time in one place that the law of large numbers starts to work for you or against you, let's be honest. But you start to see some clarity and you start to develop some skill.
Absolutely. This question also came in. The question is, what advice do you have for struggling traders who have lost several accounts? I mean, it's a very basic question. I think it's probably a good question to ask. I usually try to steer away from using the word. Some tips that you could give for someone who's just generally struggling, like they've just been trying to make something work and they're trading for a few years or a couple of years and just kind of feel as though they're not really making any progress. They've lost several accounts. What do you think they maybe need to do?
Well, okay, so let me outline the structure that I use when I coach and mentor traders, because I think, first of all, working with a coach or a mentor is one possibility, but many people can do this work for themselves. You don't necessarily have to work with somebody. So this is not an ad. This is a structure that I think anybody can use. So the first thing I do with a struggling trader is I stop the bleeding. And, I can't tell you over the years how many people have come to me and said, I'm losing money. That's the first thing they'll tell me. I'm losing money. I'm struggling. I've blown out several accounts. I'm learning this trading system. And can you help me increase my size? Now, as I tell you that, you probably can't even believe that I've been asked that, but I've been asked that many times, many times. People don't understand, it's like for some reason, increasing size will solve my problems, or they trade for prop firms that want them to increase size, even though they're losing. And of course, we understand everything that might be going on there. So the first thing you do is you stop the bleeding. And what this means is you stop trading. If you cannot learn to trade without trading. This is true. And I know many of you are already, kind of pulling on the leash and saying, but I got to be in there. I got to be in it to win it. I got to have some skin in the game. You've done that. You've lost. You've been bloodied by the market. So you've had that experience. We're going to come back to that. But the first thing we do is you stop trading and you stop the bleeding. The second thing you do is, and by the way, that's very important. That's the first thing you do. The second thing you do is, let's look at your trading plan. Oh, your what? So now a lot of these struggling traders have this kind of, oh shit, look on their face. My what? Yes, your very well written out, precise trading plan that tells me what you will and will not do in the market and how you will do it and how you will evaluate your results and how you will change your plan and how you will grow as a trader and what your plan is over, but both on the individual trade level, what markets will you trade, what gets you in and out of a market, and also, how are you going to grow this business? How are you going to know if it's working? All those questions, let's see that document. And here you can hear the thunderous silence. So most people who are struggling do not have a plan. That's, that's my point. I hope I'm making somewhat humorously here. So you write a trading plan. And there's no one right way to do that, but I have some ways that I structure trading plans. And from there, you have a trading plan that says what you are and are not going to do in the market. That's step 2. We stop the bleeding. You created a plan. Step 3 is you back test. And stop rolling your eyes. I can already hear everybody rolling their eyes. Back tests are worthless. Yes, I think back tests are almost worthless, but here's a way we're going to make it useful. And, depending on how your plan is structured, perhaps it's a plan that we can test algorithmically. Perhaps we can program it. And we have some tools to do that. Or, equally powerful is we go bar by bar. And if we go bar by bar, we're going to talk about, looking at different assets. Let's not look at just energy stocks from 2008 to 2010. We're going to look at different assets. We're going to look at different time frames. I shouldn't say time frames. We're going to look at different market regimes. Let's say that. So we're going to look at periods when the market was flat, when the market was up, when the market was down, volatility increasing, decreasing. We just need to make sure that all of this is captured in the back test. And you're going to come back to me after a period of a couple weeks to perhaps many weeks of very rigorous work. And you're going to say, I have this back test. And we're going to look at the numbers in the back test. And one thing that I can tell you with a high degree of certainty is if your back test doesn't look good, it's not going to look better if you start trading it. Now, also, you may have a back test that shows me that you're going to start trading the system and buy every building in Manhattan in 2 years. And, I would caution you, let's wait and see, because, the point is your results are not going to look as good as the back test, but we have the back test. So now we have some idea, we think, of the potential in the system. What have we done? We've stopped the bleeding. We've created a system a trading rule set, and we have back tested it. The next step, and there are only really two more steps. The next step is back test can be crap for a lot of reasons. And one of the reasons is that we've created something in a back test that we cannot replicate. A classic example would be, let's say that you have a back test where you're buying at the moving average. What people don't realize is that the moving average, what people might not realize at first, is the moving average moves as the bar is forming. So we're going to have a number of situations where, let's say the bar opens and the moving average is below the bar. And then let's say it never goes down from the open. It just goes straight up, but it goes up enough that by the close, the moving average is pulled above the open into the range of the bar. Can you visualize that? Most, if you haven't thought about it, it might be a little bit of a difficult concept, but I guarantee you stuff like that happens. And if you tell me you buy at that moving average, there's no way you could have executed that in real time. That's one example, but this type of, let's call it time machine trading, where we're bleeding information from the future somehow, happens in a lot of different ways in the back test. And our solution for this is we forward test it. So still using no money, you take a period of time, and depending on the system, this sometimes can take a long time. So, this is a commitment, but you want to learn to trade, right? That, I'm not going to give you something you can do in 2 or 3 days. There's nothing I can do to change you, to change your results in 2 or 3 days. You're going to have to go through this process of doing this work. And so the next part of this is you are basically, think of it like this, you're back testing, but you're doing it in real time. So, really it's a forward test. So you're doing theoretical executions. And yes, there's no emotion involved, and your actual executions at each stage will probably see a little bit of degrading of the edge. So in other words, your forward test is probably not going to look as good as the back test. The next stage is we start trading it with real money. First of all, on vanishingly small size. If you come to me with $1 million trading account and we get to this stage, if you're a stock trader, you're literally trading no more than 100 shares. Perhaps, ideally, I would prefer you to trade 1 or 2 shares, but there can be some execution issues there. So you're still trading vanishingly small size, absolutely no emotional involvement from the P&L. If you buy the stock and it goes to zero, you lose $50, where your actual probable risk on the trade is more like a few cents. So you're not making any money, you're not losing any money. Yes, you're paying commissions. That's tuition. We're not concerned about commissions. So we're looking at the results, backing commissions out. But what I want to see here, and I think you're starting to see the thread. We've stopped the bleeding. We've created a trading plan or refined the one you have. We've seen what kind of edge it has in a back test. We've seen in the forward test that edge can be identified in real time. That's what you've proven there. And now we're actually trading with very, very small size. And now what you're proving to me is that we can actually execute those points. And we go through the process of collecting data. And then the key idea with all of this, which probably I should have put up front, but the way I think about this is you must earn the right to trade bigger. You have to earn that right. It's your money, it's your risk, but how do you earn that right? Well, you earn that right. Now we shift into a very behavioral mode, and we're basically evaluating each trade with how well did you follow the rules? How well did you follow the system? That's all that matters. If the system is somehow jacked up, then we've got to go back and change the system, and that happens. I'm drawing a straight line here. A lot of times it's much more of a meandering path where we go back and change, then do another back. So that we can have many branches here. But once you have something that looks good back test, good forward test, good very, very small size, then you prove to me, or rather you prove to yourself, that you can execute with perfect discipline, and then you earn the right to trade a little bit bigger. And once now you're trading a little bit more meaningful size, but still probably under your target size, you do this for a while with perfect discipline. And by the way, if you don't think you have the patience or the discipline to get through this process, then maybe you don't have the discipline to be a trader, because a lot of trading kind of sucks. That's what they don't tell you. A lot of it is a real grind. And, so at each stage here, you're showing you can execute with discipline. This is where psychology, I haven't actually here, we just had an hour and a half interview, and I haven't said the P word. I don't think I've said psychology up to this point, but psychology plays a part through all of this. But, now at each phase in the process, the reason I built this out in these silos is then somebody else will probably rip the structure off, I guess, whatever. The reason I built this out into these silos is because different aspects are important at different at different areas. And here we're looking at execution skills. And here's where we also really start to focus on the psychology of execution versus the psychology of research and psychology of developing an edge, which is a separate thing. Psychology is not quite as simple as just following the rules, but at the end of the day, that's the process. So, you can work through that with somebody. You can work through that with a group of somebody's. I'm also a big believer in working in a team. Trading but you need to be careful about that. This does not mean working in a trading room where you're sharing your calls and ideas with 20 other people. I mean working with somebody where, I hesitate to use the word, but you work with very intimately, even to the standpoint, ideally, of where you would share P&L. And, I'll tell you what this does is so many traders find themselves just doing stupid shit. Yeah, just to say it like it is. How many people take boredom trades, or they get out of trades early, or they take trades, whatever. You've heard the list of things. You've probably done them. We all have. But you're much less likely to do something stupid if you know it hurts somebody else too. If you know that the money is not going to only come out of my trading account, but it's going to come out of our trading account. And, perhaps it's the fact that you're going to have to justify that position to somebody, or, perhaps it's just the fact that knowing that your actions have an impact on another human being's financial wealth or financial health. That's a surprisingly powerful way to fix some of these behavioral problems. So, you can bring somebody else into it. Or you can just go back and listen to that basic structure that I outlined and put yourself through it and be your own coach, be your own source of discipline, but just make yourself at every stage, make yourself earn the right to go on. And by the way, this is a journey. This is months. This is not something we do in days. I don't even think it's something that can be done in weeks. This is something that is done over many, many months, because within this structure, what this actually is a structure, a template to guide your growth as a trader. But it's still that. It's still you growing and developing as a trader. And that just takes time.
Awesome, man. I appreciate you really breaking that down step by step. I think that was really good, and I'd encourage anyone who is struggling, who can relate to the question I asked at the beginning, to play that over and over a few times and actually write some notes down. I think that could be really helpful for you to follow that process. And I think we may have touched on psychology very briefly when we talked about it's a misconception that going to a completely systematic approach is going to get you around all psychology challenges, which it's obviously not. Just still in line with this topic here about being a struggling trader. Another question came in which is in line with that. I'm just going to read out the full comment, as I think it sort of paints the picture a little better, adds a bit of context. So bear with me here. Breaking through to profitability is, in part, an exercise in discovering what you don't know. Discovering the unknown unknowns, if you will. Traders ultimately need the answers to questions they've yet to ask, and professional traders can help shine light on those areas. After all, professional traders have crossed the chasm, I think I said that right, between confusion and profitability, and the views from each side are very different. So I'd suggest asking Adam the following. What are the top 3 questions, or top few questions, if you will, top few questions aspiring traders should be asking but never do or often don't?
That's a good question. And, as a little personal aside, I saw your post late at night. There was a huge storm here, so I was up late, couldn't sleep with the noise. And I saw the Facebook post, and I saw that somebody had actually asked a very specific list of questions. And when I read those questions, I thought, my gosh, those are the wrong questions. And then this actually goes back to what I said in our previous conversation, where you've really developed the skill of interviewing and asking the right questions, because as soon as I got to the bottom of that, I saw you basically said the same thing. You said that these are not helpful questions you should be asking. And I thought at the time, the question that guy really should be asking is, what questions should I ask? And then this particular question that you just read came in, which is exactly that. I think in a situation, if you just go to somebody and say, well, what question should I be asking? That kind of open-ended question can speak of laziness, but I don't think that is at all the case here. I think this is actually exactly the right way to structure and think about the question, because you don't know, you don't know what you don't know. I think at the beginning, the questions that a trader should think about have to do with having a realistic understanding of expectations, because a lot of people start trading thinking they're going to triple, quadruple their money over some very small account over some year. What are realistic expectations? What's a typical learning curve? The question of how should I learn to trade? Because I think there's a lot of misguided thought about this. We have this idea that the harder we work, the better. So people come up with these crazy, rigorous ideas of sitting at a desk for hours and hours and hours, and that you have to put in your 10,000 hours, which is that's a entirely separate discussion. There's no 10,000 hours. That never was a thing. So people have all of these misguided ideas. I think that one of the right questions is, how can I best learn to trade? How can I best develop the skills of trading? And then there are things that you can only answer for yourself, in terms of risk tolerance. How is this going to fit into your life? How long? If I tell you it's going to take you 5 years to learn to trade, are you up for that? 5 years of pretty consistent losses? If that's the reality, then maybe you'll think about how to structure your trading so you can lose as little as possible. But if you believe that's going to happen, are you going to do this? Are you basically up for that? Those are the kinds of questions that I would ask as a beginning trader. And then kind of the next step is, what is your edge? What is your trading edge? How do you know that's an edge? And how do you know that edge is likely to be enduring? And that question is not so easily answered. But if you can't answer that, if I say, what's your edge? And you don't know how to answer that, you don't have any business risking money in the market until, somebody that's gone through that process I just outlined would have a good answer to that. This is my edge. And here's why I think, here's how I know that's my edge. If you don't have an answer for that question, you don't have any business trading.
I really liked that point you made about, if this takes you 5 years to learn to get to a point where you are profitable, if that amount of time does take 5 years, are you going to do this still? I think that's a really good question to ask yourself. And I've said something along the same lines to people who have, I get a lot of emails and that sort of thing from people listening to the podcast. And, I think that's really something you do need to think about and answer. If this is going to take you 5 years to become profitable, not saying that it definitely is, but if that was the case, would you still pursue this?
I'll be more pessimistic than you, and I'll say it probably is going to take you 5 years, and whatever fortunate things that happen to you inside of 5 years, whatever money you make is not likely to be sticky. I've seen lots of people who have thought they've learned to trade in a year and a half or 2 years, or people who get lucky in the first 6 months, and I guess never say never, but I've never seen anybody who really develops enduring skill that early. Most of those people, I think one of the worst things that can happen to a developing trader is you get lucky and make money at the beginning. That's a hard thing to overcome. I'd much rather see the market kick you around and punish you. And see the trader who, perhaps seems backwards, but the trader who has had nothing but losses, essentially nothing but losses, and has struggled and just been so beaten up at the beginning, I think that trader has a better foundation for success than somebody who, doubled their money buying options for their first trade.
Yeah, and that's one of the things which has been really eye-opening from doing this podcast, having spoken with so many traders and hearing so many stories about how they took years and years to actually see any signs of success. It's been really interesting to hear about and sort of paints a realistic picture as well.
That's one of the things that, back to the, what insight the quantitative types, if this was truly as purely quantitative of a game as we think it should be sometimes, I don't think that learning curve would be like that. I think this would be a problem that people could solve in more of a step-by-step fashion, and there'd be no reason for this long learning curve. But typically, even for quantitative traders with strong quantitative backgrounds, there is a massive learning curve when it comes to actually executing in the market. So perhaps that points us to, maybe we're still not asking exactly the right questions about how to learn to trade and what's actually behind the skill.
Yeah. Let's save the rest of that for another podcast.
Sounds good.
Let's close this out. Adam, where is the best place listeners can go to find out more about you?
Sure. So follow me on Twitter at Adam H. Grimes. Basically everything I put out, I kind of put out there on Twitter. You can go to my website, adamhgrimes.com. That will take you to my blog. I also have a completely free, and there's no premium area, no upsell, but I have a fairly massive trading course with 30 some hours of video that is, I've had many traders, this has been out there a few years, but I've had many traders say that, this has been the thing that has taken them from struggling to profitability. And, like I said, it's a great resource. I hope it's a great resource, but it's a resource that has helped people. And it is absolutely completely free. You can find that, again, my blog, www.adamhgrimes.com. You also can check out my firm, waverlyadvisors.com. That is everything's linked from my blog, but I do write a daily research piece that, depending on how you trade and what kind of trader you are, that might be something that could be very useful for you. I cover all the assets that I trade, so I cover currencies, commodities, stocks. We cover volatility, time frames from intraday to longer term. Our focus is on probably what I'd say intermediate term, a few days to a few weeks. So check that out there. There's a free trial. Love to have you take a look at it.
Cool. Yeah, and I have also heard nothing but great things about your free course as well. It often comes up in discussion in the Facebook group, people talking about how it, they have got a lot of value from it. So I'll make sure to include links to all of this in the show notes. Also, your podcast, are you starting that back up? I know last time you were on, you were doing it fairly frequently. It sort of faded out a little bit. Is that coming back?
It is. You and I talked about this a couple of days ago. I really respect what you've done here with building momentum and a brand, and you've certainly built a very successful podcast. I was basically less than thrilled with mine, though I was getting a lot of very positive feedback. And I took some time off that turned into some more time off to kind of figure out how to recalibrate and retune that. And I'm looking, actually, very likely I'll have a new episode out by the time you publish this. So the short answer is yes.
Oh, cool. And the podcast is called Market Life, correct?
Market Life, yes. And that also is linked from my blog. So if you go to adamhgrimes.com, I've kind of created that as a, it's kind of a hub for everything. So you'll find the podcast there too. It's also on iTunes and, every place else.
Sure. And right at the beginning, you mentioned that you have a new book on the way as well. How's that coming along? Do you have any idea for when we can maybe expect that?
Keep in touch with my blog and Twitter, and I'll let you know as it comes along. It's, for me, the process of writing a book, when everything is right, and this is an entirely separate discussion, it's rather easy. Yeah, but I just don't quite have all the pieces fitting together yet. So I'm struggling a little bit with the craftsmanship, workmanship aspect of it. But, again, working hard on it, and hopefully I'll turn the corner. Once I start to make good progress on it, it should come together pretty quickly.
Okay. So it's still a work in progress. We'll keep an eye out for it. Adam, one last question. I think that there's going to be some listeners who have listened through this podcast, and they're probably going to have some questions regarding some of the topics which we've gone into and discussed. Would you be open to answering some questions in the comments area of this interview on the website?
Absolutely. And I may steal some of the questions for blog posts, because I think the good stuff on my blog has been provoked. I guess I should say inspired, right? Inspired is a better word than provoked, but this has been provoked by smart questions from traders who, either have a different perspective or, know more than I do. So, yes, I'll address comments, and, I may build some of them out into bigger picture answers. So please, I value the interaction and questions from listeners and readers very much. So please ask away.
Excellent. I appreciate you offering to do that. So guys listening, if you do have a question for Adam, go to chatwithtraders.com/115. This is episode 115. Scroll to the bottom of the page. You'll see the comments area. Write your questions in the comments. I'll keep a close eye on it and let Adam know of any questions that come through, so that he can do his best to answer questions and share insight where he can. So, Adam, again, thank you very much for coming on the podcast, man, and giving what's almost 2 hours of your time to share your insight with listeners. It's been a lot of fun. Thank you very much.
Thank you very much. Take care.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's going on, fam? Hope all is well. On this episode of Chat with Traders podcast, I have with me the co-founder and CEO of T3 Companies. His name, Sean Hendelman. T3 is one of the larger proprietary trading firms in the US. And in case you're wondering, the 3 T's of T3 stand for trading, training, and technology. A few of the things Sean and I spoke about include how he got his start, how he lost all his money twice, and why it was a worthwhile experience in hindsight, and some of the great lessons he's learned in the business of trading. And even as CEO today, Sean is still very hands-on with T3's automated trading. So we also had an interesting conversation around this. I think some of his comments and views may actually surprise you. And hand traders need not feel neglected because there is also something in this for you too. Before we skip to the interview, I'm just going to give you the heads up. The audio quality isn't ideal, so I do apologize for this. However, I think it gets a little better as we get going, or maybe I just got used to it. Anyway, folks, please welcome Sean Hendelman. Yeah, I was expecting to catch you on your drive home. What's the deal? You knock off early?
I have something called Tiger 21. It's this organization that I was able to leave at 4 or 4:15. They bring in speakers. It's all, high net worth investors and CEOs of companies, and it's pretty cool. And so I do it once a month, and today was the day. And I did not realize it when I made the appointment. I probably wouldn't have made it, but we'll roll with the punches.
So what is it? It's like a meetup type of thing?
So Tiger 21 is a group like, there's a bunch of groups like this in the U.S., like YPO, Vistage. It's a gathering of high net worth individuals that get together, and you have to have a certain amount of net worth, and they talk about estate planning, investments, hedge fund investments. We have speakers come in. We did a event out in Boca 2 weeks ago where Michael Bloomberg spoke, Tony Robbins spoke, Zell and Byron Wien was there. You're meeting. Usher was sitting next to me. It's pretty cool.
Full on. So what are you just a member of that, or are you?
I'm just a member of the organization. There's about 400 members total around the U.S., and I'm just a member of it.
Oh, that sounds awesome, man. I'm actually trying to get Tony Robbins on the podcast. I know he's not a trader whatsoever, but I think it'd be really cool to have on. Well, yeah. I think there's a good chance it might happen. I've been in touch with his PR guys, and he's got a new book coming out, so hopefully that might be a bit of an incentive. We'll see. We'll see. Fingers crossed.
He's great. He's fantastic.
So as we know, you're the CEO and the co-founder of T3 Companies, but where did your trading career very first begin? Take us back to that point in time.
Sure. So after I graduated from the University of Michigan, I got my business degree within the next 3 years as well. I got my MBA at Stern Business School, and my trading career started on a mortgage desk, mortgage-backed securities, commercial-backed securities trading desk. We also traded government securities, municipals, at a company called Greenwich Capital Markets in Greenwich, Connecticut. I slowly went up the ranks at that end, at that company, where I was on the trading floor, dealt with the salespeople and the traders. Also, interestingly enough, dealt with computer programmers there, and had a small team of people after 3 years. And then in 1999, I decided to move away from that space, and I had some friends of mine that were active traders in the markets in around 1999, and I decided to move over with them and start a business. The business was trading. I proceeded to lose my money totally, probably 2 times, where I went from, I think I started with just $50,000 and lost that within 3 or 4 months. Put in some more money. I think I lost that too, if I remember correctly, and I kept at it. Became a very talented trader. Did all types of strategies from technicals to stat arb. I was always a very high volume trader in the equities and option space, mostly in equities. So at that point in time, I was trading a lot of volume, trading most of the high beta names at that point in time. It took me about 18 months to get good. And then from then on out, I started my own business in T3. Prior to that, it was called Nexus Capital. At Nexus, we only had like 40 traders. And from there, that was about 2003. And then in 2007, I merged with Sperling Enterprise to form the now company called T3 Companies.
Right. So there's a lot going on there. Let's break that down a little bit. So I just want to go back right to the beginning. Were you ever a retail trader, like sort of in the typical sense?
I always had a retail account where I had long-term positions, starting in 1997, graduating from school, or even early before that. I used to read a lot of Peter Lynch, One Up on Wall Street. He's one of my favorite guys. I used to call it this is where my interest started, even before, probably in high school. My interest started in trading in 93, 94. And in that time period, Peter Lynch used to say, they called it the cocktail hour, the cocktail theory, which I don't know if that's the right term, but it was close to that. And basically what it was is whatever you like to do, whatever you hear your friends talking about, whatever the coolest thing in at that point are stocks that you should invest in. So I'll never forget, I have the same book that I read back in 94, 95. I don't remember exactly when it was, maybe even earlier than that. And I remember writing down Dell, Subway, which was private, so I couldn't buy it. It was Dell, Subway, Cisco, Microsoft. Didn't have Apple because Apple wasn't in then. But I remember it was a few stocks, and Oracle was another one, and I probably had one or two losers that we probably never heard of at this point. And I remember putting in, I didn't have that much money, but I used to work as a tennis instructor over the summers at a private country club. I did that for about 8 years. And I used to make decent amount of money. I was an entrepreneur right from the start. I made decent amount of money. So I ended up I remember I put between $5,000 and $10,000 in all of those positions. My parents, I was lucky enough to have my parents pay for my college, my schooling. So I had extra money from the summers where I think I was making around $15,000 a summer. And I had that extra money to put into the stock market. So as a retail trader, I always bought names that I liked, that people were talking about. And those were the names at that point in time. I remember Subway. I still think Subway might have been my best one, because I used to love eating there. That grew my portfolio massively because that's the time period where the dot-com bubble was starting. And I remember buying an apartment. I proposed to my wife. I bought her a ring. So I did make some money off of the money that I made off summers. And I also made some money off the money that I was making at Greenwich Capital, where I was in mortgage bond securities. That was in a retail account. So I thought I was a genius. I'm going to go into active trading because I'm the genius, which, in my opinion, if I would have thrown darts at a dartboard, I probably would have picked great stocks in that time period because everything went up. But I got lucky, and then I bought my apartment in New York City, and so I took all that money out and bought the apartment. Luckily enough, that was where the bubble started popping, 99 in that area. So I went into active trading at that point, and that's really where it started. Okay.
I want to pick up on that point where you said you lost your money about 2 times over. So was that when you went into business for yourself, or was that before that point?
So I would say 3 big points in my life where I graduated from the University of Michigan, and I remember coming home and saying to my parents, I'm going to live at home. Can I have $500 for the month to buy, food, whatever. And I'll just never forget. My dad said to me, you just graduated college. There's no more money coming to you. So at that point in time, they said, if you want to go to business school, we'll pay for business school, or figure out a way to pay. But starting today, we'll have dinner, we'll make you dinner. So to me, my bank account at that point in time was close to zero. I mean, again, I had those $10,000 investments. I had some money in the bank. It was a portfolio that I thought I was going to hold forever. So that wasn't a zero amount. Then I bought my apartment, and I was cash poor because I had just gone through Greenwich Capital Markets, and Greenwich Capital Markets, I was doing very well. I ended up, breaking the 6-figure mark, which was exciting for me. And then from there, I wasn't saving that much money at that point because I had expenses. I just moved in. I bought my apartment in New York City. I was, living, probably above my means at that point in time. And I remember I had $50,000. I probably had $100,000 in the bank. I took $50,000 of it, put it into an account to actively trade, and proceeded in 3 months to lose it where my closest friend helped me trade. And the active trader market was difficult, and it was expensive to learn how to trade at that point in time. It cost money because we were buying 1,000 share lots, and I remember stocks like SDLI and QCOM, like they were moving extremely fast. So that area was difficult. It was difficult to navigate, and it took some time to get used to it. I think one of my friends lent me some money at that point in time because I needed a couple dollars. So that was one of the times that I didn't have much money. Then I started actively trading more. I did do well at that point in time, made some money. Then in 2002 or 2003, I started a hedge fund where I did okay. It was a stat arb hedge fund. It was still actively trading. It broke even. It made a little bit of return. Didn't make or lose that much money, but it was expensive to start that business. So after I started that business and didn't receive income for 2 years around that amount of time, all my savings at that point again was gone. So that was my second time I pretty much went back to zero. And I can tell you learn a lot when your savings goes down, especially to zero. You learn how to do the most important part of trading, which is being risk averse and knowing your downside of every trade. I would take that to the vault with business, with trading, anything you do in life. Understanding the downside risk and the risk reward on anything you do is extremely important.
So you said in your answer there that you lost, when you first started actively trading, the first time you lost your money, you lost it in the space of about 3 months. Do you know the reason why you lost that money so quickly?
So I'm gonna use the analogy, which I will never use the analogy that gambling is the same as trading, because that's not. I disagree with that, because you're trying to make your reward higher than your risk. When you go to the casino, which I don't do, but if you do go to the casino and you go there and with $1,000 in your hand, most people say to themselves, "This is entertainment cost, and I'm going to spend $1,000. And if I lose it, I lose it, and that's it." In trading, in my opinion, at that point in time, the $50,000 was a $50,000 to learn or get educated in how to trade. Now, that's not fun because I didn't know that was going to happen, obviously. Otherwise, I probably wouldn't have done it. But if I didn't do it, I probably wouldn't be on the phone with you right now. It was an eye-opening experience, but it was a very good learning experience, losing that money. I know that sounds crazy that, you learned a lot from losing money, but yes, that's the way everybody learns in trading, in my opinion, by looking at all your losses, how to prevent them, how to risk manage them. So that was a great experience. To me, and looking back, I wasn't happy when it happened, but looking back, I'm happy it did happen.
Yeah. What did it feel like the second time you lost your money all over? I mean, was there some sort of, you said that you're kind of glad these things happened and that really helped to get you to where you are now. But, in the heat of the moment, how did you feel at the time? Like, did you feel defeated? Were you sort of put off to actually try and make something again? Like, what was that like?
Sure. I mean, look, anybody that's lost money in their life feels at the lowest low that you can. You get very concerned about what your plan is for the rest of your life, and if you're going to have kids, and how you're going to support people, how you're going to do different things in your life that you want to do. So it was very difficult, and it was very hard to handle. The second time wasn't really a trading loss. It was more of not making money for, while running a hedge fund, which there are expenses to hedge funds like audits, administrators, risk management teams, programmers, or whatever it might be. And that was the second time. But that was more on the business side. And maybe that was understanding the reward side of the model, which I didn't understand. Understanding it now in the hedge fund space, you need a lot of money to if you're going to collect 2 and 20 on a hedge fund model. You either have to make really good returns or have a lot of capital. I had neither. I didn't have a lot of capital. I think at the max I was at $15 million, and I was running 15 million, and that's just not enough to run. If you're looking for 10% steady returns. So that was the second time, but that was more of a business loss or a business stagnation versus a trading loss the first time.
Yeah, that makes sense. And at the hedge fund, you said that you focused on statistical arbitrage. That was kind of your main strategy at the fund. Was the strategy itself sound, and you just didn't really have enough capital to support the fund?
It was a little bit of a mixture. I don't think it was doing well enough, and the knowledge that I have today, and if I had better staff and better programmers, and I call them the MIT Caltech guys on my team like I've had more recently, I would have done a lot better. I'm not a quant. I'm not a math guy. I'm pretty good at math, but I'm not a programmer. I don't know the C++ or C# or Python or any of the ways to analyze data like you need to. So I was a little behind the curve then. And would I have done better? Of course I would have if I had more capital to use either. Probably not on the trading side. That doesn't make a difference. To me, if you have less capital, that usually makes your returns higher because you're more nimble, less slippage, and so on, less market impact. But if I had more capital for the business, I might have been able to build it into something different.
Okay. So let's just summarize a few of the things we've been talking about here, particularly around the business side of it. So what have been some of the greatest challenges which you actually experienced, which you perhaps didn't expect to experience from running a trading business?
Sure. So that's more recent. So when Nexus started and T3 Company started and T3 Live and all the different pieces, there's a lot of challenges. There's from challenges in partnerships to challenges in cash flow, which to me is, if people that know me well, I'm very into cash flow. All that means is make sure you're actually receiving money more than you're spending on every given month. Doesn't always happen, but to me, I've learned that lesson where you want to keep your cash flows positive. Now, that might create a lower risk situation and you not going for it and making a lot of money, but that is a good way to keep a company stable like I've done really since 2003. And Sperling Enterprise, the company that we started, that we merged with, started, I think, in 99, if I remember correctly, or 2000. And so we've been in business for 17 years. It's not very common for almost any trading companies. So what I've learned over time is cash is king. Keeping the cash flows positive is very important. And the second piece is to diversify, obviously. So one thing that I've done is, try to understand if the market is not volatile, what would happen. If the market is volatile, what would happen? If we back too many traders directly, what would happen? Right now, our sweet spot is around 20 to 25% of traders we fully back. A lot of the traders have a bank or capital in their accounts in the broker-dealer, which I haven't gone over yet, which I can. And on the business side, those are some lessons that we've learned. You can't always focus only on trading. There has to be a lot of things to focus on. Our business is run in a lot of different ways. We can't just employ or have traders that do technical analysis. Sometimes technicals don't work. We need the fundamental guys. We need the quant guys. We need the stat harp guys. You name the gamut. We need the news traders, the Momo traders, the momentum guys. If you're really building a business, you have to have different suite of traders, because if you don't, what will happen is every trading style is not going to be in style at that given moment. And usually what happens is it's a good diversification tool or a hedging tool to have different types of traders.
Okay, and just to put things in perspective, how big is T3 now? Like you said, you started 17 years ago and you merged with another company during that time. How big is T3 today? How many traders are on your team?
Sure. We have about 1,000 active accounts. Now, we have two separate broker-dealers. One is a retail broker-dealer, and one is a prop broker-dealer, a prop or professional trading broker-dealer. The professional prop broker-dealer is a Philex broker-dealer, which is overseen by Philex. Which is overseen by FINRA. That broker-dealer, all traders that come in have to be licensed. We have 7 offices around the U.S., only U.S.-based traders. They trade equities, options, Forex. We've traded futures over the years. We don't trade that much in the future space. And all those people have to be licensed. It used to be the Series 7, then it was the 56, now it's the 57, but they all have to be licensed traders. And the way it works very simply is when Dodd-Frank came out, or any kind of Volcker rule, or any kind of rules that have come out in the space, hedge fund people with the high regulations, or anybody that has capital that wants to get more leverage, they usually come to a place like ours, which we don't have many competitors in the space. On the prop side. On the retail side, there's a lot of competitors. But on the prop side, there's really not that many. And so on that side, we have those 7 offices. And what a normal structure would be is something similar to, I run a hedge fund with $10 million, or I'm on the Goldman Sachs trading desk, and I'm running a small book of $30 million in biotech. If I go to T3, if I'm running a hedge fund, I run $30 million, and $2 million of it is my money, and the rest is investor money, and you come to T3, you might have to put in $500,000 for capital contribution, which is locked up for 1 full year for good capital rules. You put up $500,000, or you put up even $25,000, and you can get a much higher amount of buying power allocated to your account. So, for example, if somebody puts in $100,000 as a capital contribution, which is good capital, they could receive a $2 million pad. So they can trade up to $2 million, and they get a very high percent payout of their capital. In another sense, they can come to us and say, look, I have this great track record. Look at how well I've done. And then we would do something like a 50-50 deal structure. In a prop model, we make money on things like commission. We can make money on profit splits. We can make money on interest. And that's how, those are the different features or ways that a company like T3 Trading Group would make money. On the retail side, it's pure retail. It's similar to opening up and that's a completely separate broker-dealer. That is a FINRA broker-dealer. That broker-dealer you don't need to be licensed in. It's very similar to opening up a Scottrade or an E-Trade account, but we only cater to active traders. So maybe our competitors in that side would be Interactive Brokers or TradeStation, which both those companies do a great job. We probably cater to even more active traders. They could be high-frequency traders. They could be just super active traders that are turning their book over multiple times in a day or multiple times in a week. So both those businesses together, we have a lot of accounts in both those entities.
So on the professional side, you back about 25% of those traders, correct?
Yes, it's about 25%, yeah. And that ranges from 20 to 30% probably.
So how exactly does that work? Because obviously when someone comes to you, you're giving them, like you gave an example there where it was like 20 to 1 buying power. Does that not mean that you're backing them by giving them that buying power, or how does the actual backing process add to that?
It's a very good point. We basically back everybody. It's 100%. We back everybody. It's one capital base, and we back everybody. So that's technically what our firm does. What I was saying is sometimes people have none of their own capital at risk, but there's all types of ways to look at this. If a trader makes $100,000, do they keep some of that money up in their account? Usually we would want to have a cushion, because if somebody makes $100,000 and you give them 50%, and they lose $100,000 the next month, it doesn't really make much sense, because then the firm makes 50, then they lose 100, and then the firm is negative 50 and the trader's positive 50. That wouldn't be fair. So there's all kinds of things with holdbacks and banks and different types of payouts and structures. And for T3, we cater our business really to the trader. Our ultimate goal is not to have the trader trade too much or do any of those things. What we're looking to do is get traders to make themselves money. And when I meet with traders, I always say that it's very important for you to make money, for us to help you with either technology, tools, charting, T3 Live, which I'll go into a little bit, for us to help you make money. If we can help you make money, you become more loyal to us, part of our team. You last longer. You trade for a much longer period of time. Ultimately, selfishly, we would make more money if you make more money. We can open up second accounts. We open up black box accounts for that person. We can open up a swing trading account for them if they're a momentum trader. We've done all types of things to try to get that trader bigger. We can say that we're going to back them in a different account. A lot of times when we back traders, it's not them coming off the street. It's usually them being with us for about a year and getting a phone call from the head of business development, and they would say, "Can we back you? We want a much bigger split of your P&L because you're a great trader, and we want to get you bigger. We're willing to take more risk on you. You might not be willing to take risk on yourself because that could be scary for an individual, and we want to take risk on you because we see that you're a good trader."
So going back to a comment you made earlier, you said you trade stocks, Forex, and options, and very little futures. I'm just curious to know why futures is not a main focus.
And Forex is not a main focus either. I mean, we're mostly equities. Second is options. Futures, I'm going to be upfront with you. I don't understand it well enough, and it's a high levered product, and I need to have the right people in place to understand the risk side of it, like I said from the beginning of the conversation, before I trade it. Forex is another one that we do some with, and the reason why I'm doing Forex slowly is for the same exact reason. We want to understand it. I want to hire people to risk manage it the right way, and we have those people, but it's a 24-hour market, and there's other difficulties in both those spaces.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Moving on, you're the CEO, co-founder of T3 Companies, but you are still very hands-on with the actual automated side of trading. So I want to pick up on that a little bit. Can you talk to us about what you do and the types of strategies that you're running, the automated strategies?
Sure. So I'm not going to get obviously too deep into it, but I will give you some ideas of really how automated trading works. It's very simple, much simpler than most people think. The difficult part is building the infrastructure around it. I was on CNBC once in my life and against Mark Cuban and a whole crew of people that were really difficult. I was sort of blasted very quickly right when I got on there, which I didn't know that was going to happen. And it was really about one general topic, that high-frequency traders have some advantage over the normal retail guy. I dispelled that, I think, in that conversation. But what I would tell you is this. The problem even with my high-frequency trading today, or T3s, not mine, but T3's high-frequency trading today is really around the fact that we're not willing to spend enough money on infrastructure to compete with the bigger high-frequency traders out there. So And I'll get to your question, but I just wanted to make sure that that's clear. So there's market data that's very expensive. There's routing that's very expensive. There's getting the futures line from Chicago that's expensive to give you some leg up. There is co-locating in Carteret, which we do. We have multiple co-locations, NY4, Carteret, Hudson, a whole bunch of places. Co-locating your servers right where the exchanges are, getting connectivity to everybody. Then you need to do the compliance side and the regulatory side and the risk side. Then you need the programmers that are the best of the best. And still, when you come up with the best strategy, I promise you there's somebody else out there that also came up with that same strategy that's slightly faster than you. So that's where it becomes a problem. We've done everything. I'll be upfront. T3 was much more successful in high frequency trading, and from 2004, from Nexus years all the way up to 2008 was the best year, and then all the way up through the flash crash. We just have a statistic just now that we, over the last 10 years or 12 years, 96% of all days we've been positive in that time frame. And the days that we were negative, to be upfront, were probably closely related to a software glitch or something like that. Nowadays, it's much more difficult. So T3 is still making money on the technology side, and we're still having that percentage. Actually, in the last 2 years, it's over 99% of positive days. The problem is that we're just not making as much money as we used to. There's just not as much opportunity because it's a more crowded space. More people are coming to it. Most of the strategies that we run, and this could have been my biggest mistake in the history of mistakes, because when Hudson River started, when Virtu started, all these different companies that were doing this way back when I started doing it, smartly on their parts, they started hiring a lot more people. I always didn't want to hire a lot of people because I was waiting for the space to get crowded because it was too easy to make money a while back. And I wish I did what they did because they built a much bigger organization around the technology where I lean more towards the trading side. Most of the strategies that we run are momentum type strategies, very high frequency strategies. The other piece that I don't do because I don't believe in it, or I do it extremely little, is have passive orders, posting bids and offers. Most of the orders that we put in are taking liquidity. Now, there's a big reason why since 2004 I did that. I thought, and I was sort of right on this one. I was wrong about not hiring a big team, but I was right about this one a little bit, which is there's a huge regulatory issue, in my opinion, and we've done studies on this, where 98.6% or approximately 99% of all orders by bid and offer are not real, which basically means that you can go out and say, I'm willing to buy this company at $10, but when somebody's willing to sell it to, hit the bid on that $10, 99% of the time that person's not there. And then you have spoofing and layering, and all these things came to be. And then this is why high frequency got a bad name, because their comments were, well, I could get filled on the bid. So I've stayed away from having passive orders. If you look at the spiders today, SPY, you see bids and offers flying up and down, and you're like, what is going on? A lot of that is the same people flashing in and out. Most of those orders, most of those quotes on the bid and offer are not getting filled. So I've stayed away from that. Now, I think a lot of people made a lot of money doing that and playing the psychological game. I stayed away from it. I'm happy I did. Maybe I would have made a lot more money, but I know there's been some regulatory issues, so I'm happy I've stayed away from that. Most of the strategies, again, are buying small share sizes. So if you think that high-frequency guys are buying huge amounts of stock, you're completely wrong if anybody thinks that. Most high-frequency guys are trading very small size. Now, they can get bigger in their size, but they're not showing their hand. It's like if you walk to the poker table and you had your hand out, and you're showing your hand, and you have a whole group of people around you that all has their hand, hidden, you're going to have a huge disadvantage. So hedge fund guys, they're not showing their orders for real, and they're also not taking liquidity at big size, because that also shows their hand, because those go off as prints. So most high frequency traders are usually buying small share sizes. And so do we. But we've done all types of strategies, from new strategies all the way down to scalping for trying to buy at one price, doing AI, artificial intelligence, where we're learning machine learning of how one particular stock might trade in a given environment. So we've done everything. I mean, you name the strategy, I've probably done it. I've done short-term stat arb. I've done every type of equity strategy. Somehow in the last 10, 15 years, we've done it, either on the manual side or on the high frequency side.
Okay. So a lot of what you're talking about here is latency sensitive strategies. To this day,
yes.
Yeah. Are you running strategies that aren't so latency sensitive as well? Like, because you said right at the beginning of your answer there, you said, most of the strategies are very simple, but the tricky part with automated trading is that you need the infrastructure, but you only need the infrastructure if you're running, or, to a certain degree, if you're running very latency sensitive strategies, correct?
It's 100% correct. So when I said it was simple, what I'm saying is, if you have a strategy today and you say, if a stock has an ATR, average true range, of $1, and you figure out you figure out, I want to trade these 200 stocks today, and you decide that anytime any of those stocks go through its 52-week high and retraces 0.5%, then buy. It's a simple if-then statement. They all are. So if this happens and this happens and this happens, then do this. When I say it's simple, that's really that's all it is. It's not some crazy, yes, those statements can get really long, and people are looking for every type of advantage they possibly can, but the process is simple. It's what you learned in math class or in anything that you do in life. And when your brain thinks if a trader is sitting there, I always tell traders, know what you're going to do. If Trump gets elected, these are the 20 stocks I want to trade. If Hillary gets elected, this is what I want to do. If we have gas prices go up, these are the stocks I want to short, these stocks I want to get long. That's an if-then statement. This is what I want to do. If there's a terrorist attack in France, again, what do I want to do? If there's a terrorist attack in New York versus Florida, what do I do? If there's a drought in California, what do I do? It's an if-then statement. You're literally walking through the steps. You might want to buy trucking companies if you think, people are going to have to, you have to know each and every single little if-then statement, no matter what you're doing as a trader. It's the same thing on the high-frequency side. Most active traders, people, don't really understand that that's what their brain is doing. If somebody goes high bid, then I'm going to take the offer. If the spread decreases to 3 pennies from an average spread of 10 pennies, I am going to take the offer. This is what most traders are doing in their head, and that type of thing can be automated. The problem is that if you would have done that in 2004, 5, 6, 7, 8, you would have done extremely well. Now that space has been flooded, and it's much more difficult to succeed. The medium frequency trading, we do also. So the low-hanging fruit for the super high-frequency trading, it's very difficult to make money at this point. We still do pretty well, but not as well as we used to, and it's difficult. It definitely is difficult. There's a lot of big players out there that are taking that low-hanging fruit. We are involved in some medium-frequency type strategies. We work with traders to build strategies for them. That's part of our technology group. So all kinds of strategies. I mean, they could be technical type strategies. My partner, Scott Redler, he talks about the red dog reversal, 80-20. Those types of strategies I'm not going to go over the strategy, but that kind of thing we can automate. So if you have any type of if-then statement, you can automate it. And I think there's some great technology out there outside of T3 that does that for you. I'm yet to hear people being very successful doing it because I think the space is crowded. Just my opinion.
So when you say that you think the space is crowded, what exactly do you mean by that, and why is that a disadvantage?
Sure. So like any other business, I say the turning point was when there was a programmer at Goldman Sachs. The cat got out of the bag. The guy took the program, and then everybody started looking at Goldman Sachs's 10K and quarterly earnings, and they're realizing that a lot of their earnings was coming from black box. And there was one programmer I don't remember exactly what, I think I do know his name, but I'm not going to say, but there was one programmer that went to another company and there was a big lawsuit. It was all over Wall Street Journal and everywhere. That was literally when that happened, everybody started understanding what was going on, in this space, and it became much more crowded. So anything in life, if you want to sell hamburgers and McDonald's opens and then all of a sudden there's Wendy's and Burger King, trust me, McDonald's would be doing a lot better if Wendy's and Burger King weren't around. And we all know that. What happened was that there were only a few players in the high frequency space. And what happened once it got out that people are making this much money, which I thought that was the turning point, just my opinion. When that happened, everybody flooded the space. And when everybody floods the space, you know what happens with anything. It becomes we're all sharing the dollar. So if there's X amount of dollars to make, if there's $100 a year to make, and there used to be 100 people, now everybody's making $100 each. Now there's 10,000 people. You're breaking up that $100 a lot more. That's what I mean by crowded.
Yeah, I thought when you made that comment, just before I asked that question, you were referring to more of the mid-frequency strategies, but I must have misunderstood. So,
I'm sorry. I was talking more about the high frequency, but medium frequency strategies, interestingly enough, look at the VIX today. The VIX is going straight down. Everybody's asking me, Sean, what do you think? Why is VIX so low now? Look, my personal opinion is I think, the VIX it's crazy how low it is. And at some point it's going to turn, but I still think that things are priced in very quickly. Go look at when earnings come out, what happens to the stock. Go look at when news comes out in the marketplace, what happens to the market. It goes straight down and then it goes sideways. The reason why that's happening is because the boxes, there's so many people doing the high frequency, super high frequency stuff that everything's being priced in quickly. On the medium frequency side, that is also happening where if you have a stat arb that you're trading Coke versus Pepsi or a common versus a preferred, things are being priced into stocks very quickly. Even if it's long-term pairs or any kind of longer-term strategy, that is what's happening. So things are being priced quicker. And when things are priced quicker, what happens, in my opinion, is the efficiency and the edge goes away. So no matter what you're trading, if there's a lot of people trying to do medium frequency or high frequency, they're both going to go away slowly or be much more difficult, or the best will rise up to the top, and it does become more difficult. I will say on the medium frequency, it's definitely a more even playing field, because it's not as expensive to run a medium frequency type of box. So you don't have to be co-located. You don't have to have the best routing or the best market data or the best whatever and spend all that money per month.
So with that being said, we had a phone call it was a couple weeks back prior to doing this interview right now. And we were just chatting, and I said to you how I was focused on algorithmic strategies myself. Certainly nothing in the realm of high frequency trading, more sort of intraday and multi-day strategies. And you were still quite negative on the idea. I don't know if negative is the right word, but you almost said you tried to discourage me from it almost.
Yes, I remember.
So I just want to pick up on that point and hear your reasons for making those comments. I think it's going to be might spark some interesting conversation and might be valuable for listeners to get your thoughts on that. So yeah, please share. Sure.
So look, I'm very a numeric guy, so my only data point is really from experience. And having traders come to me and saying, I'm going to do this, I'm going to do that. If it's in the high frequency or the super high frequency space, I would say your success rate is going to be close to zero. If it's going to be in the middle frequency, like what you had mentioned to me about yourself, there is a higher success, but I think it's really low. And I'll tell you why. And this is my reasoning, is that I've just watched so many people come to me. I have tried to program people's strategies, and always, they've either overfitted the data, they don't understand market impact or slippage, which means when you go to get the stock, you're not just getting the last print. You're paying the spread, and you are losing commission dollars, and you're also having market impact of the stock. There's a lot of things in the slippage world that really come into effect. And what I've seen is it might back test fantastically. I don't back test ever, by the way, just as a side note. If I'm ever going to come up with a strategy, one piece of advice that I tell everybody is always forward test. Build your strategy, let it run with 100 shares, be willing to lose a couple $1,000 because if you back test and you try to get all that data, it's going to be much more difficult. But when you do forward test, it's still, from my experience, the failure rate is extremely high from traders. Doing something on TradeStation or Interactive Brokers or whatever it might be, the success rate is very low. And if they are successful, for that very small percent of people that are successful, they're successful for a very short period of time. So that's what I would say. I hope that doesn't burst a lot of people's bubbles, but it's a tough market. With the volatility where it is, it's probably even tougher. I hope that answers your question.
Yeah, no, it does. It does. So, there's measures and things that can be done to try and reduce the amount of curve fitting that's done when you develop any strategy. You can factor in slippage when you're back testing or your analysis. I know you said you don't do back testing, but many people do. You can also, market impact. Yes, that's certainly a factor, but certainly more so when you're trading bigger size. If you're just trading 100 SPY, you're not really going to impact the market too much.
Correct, 100% correct.
So, with those things being said, do you still feel the same way?
Look, I still feel the same way. I would ask you this. Okay, everybody trades SPYs versus the underlying basket. Everybody trades IWM versus the underlying basket of that ETF. Everybody's already doing this stuff. And looking for an inefficiency in the marketplace, the smart guys, the Caltech, MIT guys, the really good programmers, they're already are taking advantage. The only way you have an edge is if there's something that you believe that other people don't. Now, back in the day, that used to be insider information. Most people never called it that, even more recently. That doesn't really happen anymore because the regulations have been so strict. That could have been people's edges, possibly. There aren't any edges out there. There's not something that I wouldn't think that other people don't know, and they have better technology and better programmers doing it. I will say on the medium frequency side, there are still opportunities out there, so I'm not going to be completely negative on that. But it's still, whatever your idea is, it's still going to be extremely difficult to implement it first, and it might cost money to implement it. And it might actually make money, but after commissions and could be market impact, it could be paying the spread, whatever it might be, there are implications of all of those things. Have I seen it work? I just built somebody a strategy recently that's working very nicely. It's not scalable, and it is more medium frequency. I don't love the standard deviation, though. It's making money, but again, the standard deviation is too high for my taste. It's very small, but I'm just saying the standard deviation is not exciting for me. So I always look at everything risk-return in a risk-return basis. What's the worst-case scenario? And again, if you're trading small, it's probably okay, but I'm with you.
So, yeah. So what you're saying here is pretty much whatever you find someone else is, if they haven't found it already, they're going to discover it very soon. And, that's a common argument that you hear. You're not the only one who says that sort of thing. But I kind of have a little bit of a tough time getting my head around that because, surely there's an infinite number of different trading strategies that one could come up with, right?
Correct. And yours can be slightly different than other people's. But remember, if somebody is generally doing the same type of concept, the best black box traders are constantly changing. You have to be changing your strategy. So they will be changing their strategy to find. We run on our test. I have a test broker at T3, and we have probably 300, maybe less than that, maybe 200 strategies running every day. And we're monitoring, and we have a whole other set of strategies that are running live. So we have live strategies and brokerage strategies that are without real money, that have slippage, everything categorized in it. We're looking at all those strategies, and then we're making changes on them. If one is making money, you focus on the ones that are making money. The ones that are making money, you want to turn them live, and then you want to try every single different variation of every variable that you possibly can to figure out what the best risk reward return would be. That's what everybody's doing. So if somebody's trading something similar to you and you're making good money, somebody's going to find that also. Now, I have had the conversation I'm having with you right now on this call with so many traders, and I always end up saying, I will help you, we'll do it. And then the 1 year later, Sean, I know you told me this. I should have listened. It's not working, and I spent $25,000 trying to figure it out. And it always happens the same way. I mean, I can if it's for every 10 guys, one works, maybe even less, half of one. Out of 20, one works. And these are smart guys. These are smart traders that have been trading for a very long time, trying to automate what they're doing.
Sure, but that like sort of success ratio, I mean, that's sort of the general success ratio amongst traders in general, though, isn't it?
Fully. But this costs a lot more money, though.
Okay, so with this being said, let's say someone is interested in automated trading. They are interested in algorithmic trading like we're talking about here. They're going to push ahead regardless of what you say.
100%.
What advice would you give to them? Like, what suggestions would you give to them? Just maybe save them and help them out a little bit.
For high frequency, middle frequency, or active trading, just regular active trading?
Well, I presume if we talk about mid-frequency, it's probably going to be relevant to more listeners. So let's focus on that.
Well, and look, mid-frequency is the same as an active trader, in my opinion. It's an if-then statement that you could be trading manually as well. So it could be a gray box where you're getting alerts. This is what I would tell every trader before they do this. Whatever time frame you think it's going to take to get this running, double it. Make sure you have enough capital in place to be able to see it through. And then make sure all of your slippage components are very conservative, meaning almost like if you think your commission is going to be X, do 2X. And don't overfit the back test. Those would be my suggestions. The number one reason why that doesn't work is because it takes too long to implement, and they don't have enough capital to take the losses in the beginning. Those probably are why most people fail on the mid-frequency black box type side, because they have to pay a programmer, they have to get market data or whatever it might be. That's where I'm seeing the biggest failure rate. The quickest failure is from that. Scope out a plan. Pretend it's like a business where you're running a business. That's my piece of advice.
Can you just pick up on the point of needing enough capital to sustain the initial losses? Like what are the initial losses? Are you talking about if your strategy goes into drawdown as soon as you go live, or are you talking about other expenses and like?
Both. They're all of those expenses. On medium frequency strategies, even if you're trading 100 share lots, you could probably lose more than you might think. The strategy could be good, but depending on when you start, a good strategy would make money 55% of the time on a medium frequency, even 50% of the time, and then the winners are bigger than the smaller than the losers. The problem is that when you start, that would be a good success rate after 6 months of running the same strategy and tweaking it. And constantly tweaking it and making it better. What most people don't realize is that you're going to have to tweak it. You're not going to come up with a secret sauce right when you do it. It's going to take some more time. So there could be losses there capital-wise. There could be your savings loss, meaning you thought you were going to be making money quicker. There could be loss of dollars for co-location or brokerage fees or market data or port fees, or there's tons of different fees that can happen. And then also understanding that if you don't make money for the next year, do you have enough savings to support yourself? So all of those it's really three things. It's savings to support yourself, it's the cost of trading, and then it's the losses that you could incur while you're tweaking the strategy.
Yeah, okay. And I know I'm jumping around a little bit here. You've just mentioned tweaking again, and then a few minutes ago you talked about you don't back test, but you sort of optimize the strategy and you try all the different variables when you actually go live. Is that not the definition of curve fitting? I know you're not doing it in a back test with in-sample data. You're sort of doing it in live, to some extent, out of sample data. But
okay, so I'll tell you, I'll give you a little bit of what I do. If I have 50 strategies, if T3 has 50 strategies running today, which is around what we have, and I'm running 200 strategies we call it a test broker, which is not real money. The 50 strategies that I'm running live, I'm also running those 50 strategies in test broker mode. I'm trying to make the slippage perfect between those two. They're never going to be perfect, but try to make it as close as possible for those two. If I can make those two perfect and it understands the slippage, I call that forward testing. I call that we're testing all of these strategies, these 200 strategies, and 50 are running live. And if they're making money on test broker live, either live or on the test broker, I would want to go from test broker to live the next day, possibly. So I don't know if you would call that overfitting or not, but we have stats, standard deviation stats, 1 minute bar. But again, I'm more on the high frequency side than the medium frequency. So it's definitely different. Most of my strategies that I'm testing are more on the high frequency side. So it's probably not as applicable to that. But what I don't like is somebody comes to me, take a look at this, Sean. We went back 3 years and look at these returns. Look at my Sharpe. Look at my standard deviation. And I start laughing. I'm like, did you run this? My first question always is, did you run this with real money? No. Have you ever run it with real money? No. So I say to them, okay, so you ran it for the last 3 years. So how do you know that the next 3 years are going to be the same? And how do you know that somebody didn't run that exact strategy that you probably overfitted over the last 3 years? Those are the things that I don't like as much and I'm not a big fan of. I do it a different way where I'm forward. I call it forward testing, where you're just actually implementing the strategy with live data, live running, and you're taking the standard deviation of minute bars and P&L per trade and doing all kinds of standard deviation Sharpe ratios and risk versus reward on those types of strategies.
Okay, and out of those strategies that you have running with your test broker, you've got anywhere from 50 strategies upwards at any given time. How many of those strategies actually make it to live trading with real money?
Oh, very few. Very few. I mean, look, right now we have probably about 50 strategies running. Some of them make, I think I have a strategy that barely trades ever. And when it trades, it might make $20 in a day. But why wouldn't I run it? Because it over the last 3 years, it's always made money. So, and when it makes a trade, it has a 80% success rate. You have to realize, now somebody might laugh at that and say, well, why would you, that's a waste of time. It's not, because I already built the whole infrastructure. So why wouldn't I run the thing that makes $20 every third day? There's no energy off me. It just runs in the background. And then you're analyzing that. In terms of the other strategies, usually when they're not working and I'm running them, usually I'm tweaking those strategies to try to make them work better. We see something. Maybe there's a type of stock that trades better on that strategy. Maybe there's a time of day that is better for a certain strategy, which is very common. Some strategies don't work well in the morning with high volatility. Some trade much better early in the morning or very well in the last 10 minutes of the day.
Let's do this. So the way you see it, in your position, you see a lot of traders every single day. You know what's going on. What do you see are the main advantages of automated traders compared to hand traders? Like, what's the pros and cons of each? Just like the big points.
Okay, well, I'll always tell you that on the technical front, I believe that a hand trader is always better. I think they react faster to change. They can analyze the market faster. I know that sounds crazy. It's not faster. I take that back. The word's not faster. More intelligently, understanding things that are going on in the world or with a stock, or have seen that same pattern before. Looking at ranges, if you're trading a black box, you have to know a price. You can't look at range. It's very difficult to look at ranges. So as a hand trader, the advantage is pattern recognition, seeing things happening over and over again. And I know there's software out there that does this. I still think the human brain is ahead of of black boxes in that sense because I see very successful traders. And to me, if you see very successful traders and they're consistently doing well, they obviously have some kind of advantage. I will tell you that the more momentum type traders are going away. The guys, like when I started buying and selling very quickly, the black boxes have taken over that area. That's the area that if you're a trader doing that, start changing your style into a little bit of a longer term outlook. It could even be 2-hour outlook versus buying and selling quickly in 3 minutes. I'm seeing that if the whole time is longer, hand traders are doing better, which is a case for your medium frequency concept. I just will let you know that versus high frequency. And then your question goes to what is the advantage of a black box? Very simple on the black box side, which is the space that I understand well, is you can program something, you can change it, and you can make it do exactly what you want it to do without emotion. The best traders that I see are the ones that don't have as much emotion or get very emotional only when they lose money. They don't get excited when they make money, and they understand that it's like swimming on a wave. You have to go with that wave. If you go against the grain or you think you're too rich or you're making too much money, that wave is going to smack you in the face hard. So I'm getting off topic, but on the automated side, I think it takes out the emotion. You can really prepare prior to the trading day because you can get the strategy in. And obviously it's much faster than a human being buying and selling securities. I will tell you something that we didn't discuss just very quickly is the gray box side where it's assisted, picking, it could be a scanning software or something like that. Those things are good also that can help a trader become better and be more selective in stock selection or many other things.
Yeah, massively. No, I think that's a really great answer, Sean. Let's do 2 last questions, quick questions, just for fun, just to put you on the spot. Best piece of business advice?
Best business advice. Business, not trading. Business?
Business, and then we'll do trading. So hit us with your business advice first.
Definitely on the business side, change. And that sounds crazy, but there's a book. I think it's a bestseller. Who Moved My Cheese? Adapt, change. Don't be scared to make changes. It's more risky not to make a change than to make a change. I know that sounds like a simple one, but it really, really rings true. And my second one on the business side is look at your cash flow. You don't have to be an accountant. It's money in, money out. Very simple. I made $100. I spent 80. Congratulations. You have a profitable business model. I am not a big fan of the .com stuff. It's not in my belly to take that kind of risk where I'm spending $100 on marketing and the return is $10. Change. Don't be afraid to make mistakes. I love the cash flow idea. And then on the trading side, risk management and emotions. You got to keep both really in check. And preparation, I would say, would be the last thing. The best traders are in the office very early, reading, adapting to new markets, and that's extremely helpful.
Yeah, and I think your business advice highlighting the importance of change is also very applicable to trading as well. So
it is 100% adapting, flexible, change. Don't try to beat the market. You're never going to do it. Don't beat yourself either. Stay very even keeled. Have a mantra. Scott Rether, my partner, is a perfect example of that. He works out. It's unbelievable. He gets into the office exactly at the same minute every single day. He studies the market at the exact same time. He leaves for the gym at the exact same time. It's amazing what this guy does. And if you live by that stable, structure, it actually makes you a better trader. It's weird, but it does.
Cool, man. Let's leave it at that. Sean, if anyone listening wants to get more info about you, where should they go?
Anybody can email me at Sean, SEAN, at t3professional.com. Our website is called www.t3live.com. Our trading website is t3trading.com. t3live.com is the education, and t3securities.com is the retail side.
Sure. Well, I appreciate you coming on, Sean. I've enjoyed this conversation, and thanks very much for your time.
Thank you very much. Take care.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey there, team. What's good? Welcome back once again. With me this week for episode 117 is trader Larry Alantoff. If the name rings a bell, then chances are you've seen the TV series Wall Street Warriors, where Larry was featured on season 2. Larry's had a long-lasting and impressive career as a trader. In his earlier years, he worked as a prop trader for Paul Tudor Jones. Later on, he ran the largest group of traders on the AMEX at the time. Then, when he went over to the New York Board of Trade, Larry became the largest trader in frozen concentrated orange juice. Nowadays, Larry is CIO of the Toro Fund. During this episode, we cover the thing which helped Larry to become consistent, why there's great opportunity in knowing when things that should happen don't happen, how he's been able to successfully apply a similar trading method from the floor to the screens, and how a market obsession has carried him this far. Please enjoy the interview, guys. Hit me up on Twitter if you have any thoughts at Chat with Traders. Here is my guest from the state of Florida, Larry Alantoff. Larry, what's going on, boss? How's your day been?
The day's been actually sort of interesting because the United States markets are really, really slow right now. The actual indexes aren't doing much, but tomorrow we have a Fed meeting. So we really spent the day trying to model what we think should happen tomorrow based on 3 different scenarios that the Fed might do. So basically, most of our day was dealing with that type of stuff, which we normally don't do, but we'll get into that. But today we actually did do it, and the markets are quiet and giving us a chance to do that. So, and there's some interesting stuff with that we'll get into.
Yeah, I definitely want to pick up on your mention there of modeling what you think may happen tomorrow. So let's circle back to that. To get this started, I know you've been trading for around about 30 years, which is a fair while. Where and how did you first get started, though?
Oh, Aaron, that is actually a great question, and it's it's a funny story. Believe it or not, on October 19th, 1987, I was at the University of Michigan, and I was eating lunch, and one of the guys that I was eating with had mentioned to the whole table, did anybody see what was going on in the stock market? And literally, I finished lunch. I went downstairs into the basement. I was totally by myself, and I put on what was then FNN, which is now CNBC. And sure and behold, the stock market was literally crashing, and it was down 20-something%. That moment that I sat there and watched TV, I was hooked and obsessed. And I've been that way, fortunately or unfortunately, for 30 years. And that's literally what got me totally involved in the markets, was that specific day.
So had you had any interest in the stock market at all prior to that event?
I knew about the stock market, and I had watched some stuff, but I never really thought about it in terms of what it meant and in terms of, how to think about it properly and the correct way. And what's funny about that day was that I remember there were a couple of quote unquote gurus that, they claimed that they actually called for a crash. And when the crash came, all of a sudden the entire media wanted to speak to them because now they were a guru and they could tell you what was going to happen. Well, I specifically remember one of them, and they were saying, well, now that the stock market crashed, we're going to go into this Great Depression. So I'm sitting there, I think it was my sophomore year of college, and I'm like, well, I guess if we go into a depression, I need to change my career. So at the time, I was getting a degree in finance. And I said, you know what, I better maybe do a dual degree so I won't have to worry about it if we're in a depression. And I actually went and became an accountant as well as a degree in finance. So I double degreed basically because of that day.
Okay. So how did you begin learning how to trade? I mean, we're probably skipping a short period of time here, but when you decided that you were going to start trading, how did that sort of come about, and how did you begin learning the stock market?
I totally started probably a little different than most people. I literally I got graph paper, a giant poster of graph paper, and I started plotting prices in my dorm room after the stock market crash. And I was watching gold and the S&Ps, and literally every single day I would track the high, low, and close, not knowing anything at all. And over a period of time, I started to notice what I call a pressure point, and whereby the market would either go up big or down big. And I was able to start to sense it before it happened. So I would see something, for example, in the S&P, and I would have a pretty good inclination that, the next X days we're going to be strong to the upside or strong to the downside. So that's literally how I started. And after that, I did what probably most people do and go to the business library or the bookstore and get as many books on trading and people that traded as possible as you can get.
Okay, and these pressure points you refer to, is that something that you continued using sort of moving forward, or was that just sort of where you began to cut your teeth?
No, I did. I used those points in virtually every single market, mainly futures markets for the most part, but that's where I really started to put together a track record, and it was small, but it was consistent. And those pressure points completely existed, probably do today, but they were very, very clear back in the late 80s, early 90s. And a lot of people talk about, there were some big trend followers back then, and the markets have obviously changed, and the markets always change. So for me, for the first X years, 7 years, 6 years, I was completely using that method that I had literally taught myself. And I could take the graph or the chart and I could turn it upside down and I could see it from the opposite way. And I would literally my mind just started to totally look at different patterns. And I could see patterns just from the open, high, low, close, like other people can. But I was doing it at such a young age that I was kind of getting in rhythm with the markets, if that makes sense.
Yeah. So what is a pressure point? Can you just kind of, I know it might be a little bit difficult to explain because we've only got audio here, but can you just give us a basic idea of what is a pressure point?
Yep. And it's very simple. It's basically what is known as, for example, an ascending triangle. It's basically technical terms, basic stuff like an ascending wedge or a triangle whereby the market's gone, or even a market that's gone completely sideways for a period of time, and you're literally looking for a breakout in either direction. And you can overlay that market with an indicator, for example, like a stochastic, and you can start to notice divergences on that chart where the stochastics today are higher than they were recently, but the market is making higher highs. And you can tell, and you can start to get a sense that if it breaks above a certain level, the market can really take off here.
Have you found those sort of things to become less reliable over time?
So I think what happened is they've certainly become, I don't want to say less reliable. They're reliable, but in the what I'll call the old days, a move from one of those pressure points could last weeks, if not months. And I think today, which is something that we definitely need to discuss, but the way that information works today, these moves can happen so quickly that it's literally incredible. What used to take 2 weeks or a week can literally happen in an hour now. So it's a little trickier because of that. And I think some of that has to do with the information flows that are going on.
When you say those moves can happen in the space of an hour, are you talking about like the same amount of range, or are you just talking about the actual move is over and done with a lot quicker?
Well, yeah, it's a combination of both. Right now in the stock market, for example, I'll use that as an example. We have these high frequency traders, and basically they're sniffing out order flow. And when orders come in to buy, oftentimes they're running in front of these guys, and they're moving the price up so rapidly and so quickly that in the old days when there was a specialist and the price would move a quarter at a time, it was a little different. You had more time to evaluate, to think, where today you don't have that time. If your order wasn't in, you could literally miss the move. It can happen that fast, and the models have to adjust. Now, that's not to say if we get some crazy supply-demand situation, the markets will trend. And the markets can trend, and they do trend. But the trends look and feel a little bit different than they do back in the 90s, if that makes sense.
Well, let's continue on the path of your journey as a trader, if you will. So I think the first actual job you got in markets, you worked at Refco. Can you tell us a little bit about that? I think that was a Forex broker, if I'm correct.
Yeah, they were at the time probably the largest foreign exchange broker. We competed with all the banks, Citigroup, Citibank, JP Morgan. And basically what I was doing was running a desk and actually learning how to be a market maker in foreign exchange and metals. And over the course of about 6-7 months, I picked it up pretty well, and I ended up running the desk. So I was actually running the overnight desk. So I had kind of interesting hours. I worked like 2 p.m. to midnight, New York time. But the experience that I got from there was just being, making a market and learning how to kind of get out, get in, get out, get in, get out, that kind of thing. And trying for the most part not to take too much risk. What was interesting was my boss at the time saw that I was able to, and I was using these pressure points again and watching the order flow in the markets. And my boss said, "You know what? We think you should trade for the for Refco. You should be have a line and trade. And I did. And I was fortunate, and I started to become very, very consistent in the markets. And one of the, I don't know if it was my boss or somebody else, and I don't know if you want to go into that story, but had brought my name up to a market wizard, basically. And I started managing money for one of the market wizards. And that's basically how I ended up going from Refco to working for basically Paul Tudor Jones. I jumped the gun.
That's awesome. Before we get into you meeting Paul Tudor Jones, which we're obviously going to spend a little bit of time on, I want to pick up on your mention there of becoming very consistent. How were you able to become very consistent? Can you relate that to anything? Was there anything you did which really helped you to get that consistency?
Yeah, I can. It's very, very interesting. There is a fabulous book called Reminiscences of a Stock Operator. And it's by Edwin LaFay. And it is an absolute classic. And I every one of my traders that have worked for me have read that book at least one time, if not more. In that book, there's one of the stories when the head trader, Larry Livingston, basically goes bankrupt, loses his money. He comes back with a stake, and he's only really can trade one thing and one time, and he has to be right. If he's wrong, he's basically completely done. If he's right, he'll get a bigger trading line, and he can come back. And the thing is about that is that if you think about it, I kind of back then did the same thing. I would say I would wait for every single thing to line up before I made the trade. Everything. So I wouldn't just take good trades or what I thought were going to be a good trade. I would take great trades. And I would put the probability of being successful completely in my corner, if that makes sense. And instead of just throwing darts and being all over the place, that's kind of what I did, back in the beginning, is that I just superly made sure that everything lined up. And it's kind of modeled after what he was able to do or what he did in those books.
So I guess in some ways it was about being very strict and very disciplined in picking the sort of trades that aligned with your plan. Is that a fair statement?
Absolutely. Absolutely. And that is absolutely critical to have your game plan and be able to be extremely disciplined and not be influenced by, noise or something else. And that was a huge key for me. And I learned that really early on. And to this day, it's the same thing. And to be successful and to survive, you have to have the utmost discipline and, basically a rigorous game plan that is well thought out before the trade's put on.
All right, Larry, well, tell us about how you met Paul Tudor Jones. How did this come about?
So after a while working for Refco, I started to put together a fairly decent track record. It wasn't over the course of years. It was over the course of maybe 9 months, 8 months, something like that. But it was very, very consistent, and it was very, very good. And I got introduced, not specifically to Paul, but somebody in the Tudor group, and I think they had started a program a year earlier or 2 years earlier, and they were, from my knowledge, they were picking approximately 20, 25 traders that they thought would be good, and they were going to allocate money to them, and those traders would basically trade piece of Paul's funds, if that makes sense.
Okay, and that's what you did?
Yeah, so I was accepted into the program, and literally I left Refco, and I started to trade. I started to trade for Tudor, yes.
Okay. And whereabouts were you trading? Were you trading from an office? Were you trading on the floor at that stage?
Yep. No, I was trading. I was trading off the exchange floor, and I had a little office over at the same firm. I had an office over at Refco, and that's basically where I was trading, and that's basically where I did my trading. And I continued to do the same thing. very disciplined, watching the markets, looking at the markets, and picking my spots where I thought that momentum would carry the day, if that makes sense. So I was still using, the basic technical stuff that I had taught myself that was working, fairly decently across all markets. It wasn't like it worked in one market and not somewhere else. It worked across the markets. It was the same human psychology that when it exists, it doesn't matter where it is, it exists.
And did you have much interaction or much to do with Paul during that time while you were trading his funds?
No. We were basically we had spoken to people within the group, and I can tell you a story about that, but we were basically had no guidance at all from Paul. We were completely separated from them, from what they were doing, and we existed basically on our own.
Okay, right. Yeah, I'd love to hear that story that you hinted at.
Well, sometimes things are Paul's known for being completely a genius, and he is. And I remember back in the old days, they used to have faxes instead of like emails and stuff like that. And I remember that one day I went over to the fax machine, and there was a piece of paper that came through the fax. And I just was talking to one of the other traders that I think was also managing money for them. And lo and behold, it looked like it had a list of all of the traders' positions. And you started to put one and two together, and you could see, here was something that you're out trading for him, but you realize that the genius part of it is he's building a sentiment indicator or something to see where traders may lie. So, for example, if everybody was long cocoa and, somebody in their group would know that, that's valuable information. Because if we're all long, then maybe, a lot of other people are long. And it kind of dovetails with the end, what I call the end of those pressure points. And the market started to get a lot choppier towards the end of that. And I always wonder if it kind of runs amok between the two, if that makes sense. Everybody was trying to game something else.
Yeah. So he was trying to, when you describe it as a sentiment indicator, you're talking about amongst the traders who he had funded?
Yeah. So he had funded traders, and, obviously he keeps track, somebody in there was keeping track of everyone's positions, and it just gives really, really good information to, to an amazing trader, to somebody, a great trader. It just gives more and more information about what other people are doing in the markets, as opposed to what people say they're doing in the markets. These are what people are actually doing in the markets in their positions. So we probably weren't supposed to see that fax, but it was nonetheless, it was interesting. And for me, I was always, which started again in the 1987 when I was watching, I've always questioned things. I always ask why is something happening? Why is a market moving? What's going on? And, you question everything. So you start to see that, and it's just, it's like, wow, okay, you can get valuable information if you know what other people are doing. And it's ingenious and it works.
Yeah. And even though you didn't have a great deal or a great amount of interaction with Paul himself, obviously you were very familiar with who he was and the sort of level that he was trading at. Was there anything which you picked up or you noticed about him that really made him such a legendary trader?
Just the stories that, basically that everybody heard, starting down in the New York Board of Trade when he made some unbelievable trades in cotton, and obviously the stock market crash of 87. If memory recalls, I think he made like 25%. He called it. He had an analog model that matched up with it pretty well. But, for the most part, people that have existed for so long in trading, it's definitely cool to see not only how they evolve and what they do, but, how they do it and how they go about it. So no real dead secrets from what they're doing, but they're very, very good, obviously.
So you spent a bit of time trading Paul Tudor Jones, his funds. You then went on to trade the funds of another market wizard who will remain unnamed for now. But tell us a little bit about how that opportunity came about and what sort of things you were doing at sort of the next milestone in your career.
Yep. Well, that actually, the other market wizard came several years later. It is something that actually your viewers might find interesting with Paul. If you want to just go back for one quick second.
Yeah, sure.
So I think this was the third year of his program. And I had remembered speaking to the other traders and again, I was 22, 23 years old. At the end of the year, the successful ones not only got paid, but they were getting this, I think it was like $10,000 bonus. So obviously I was very, very excited. I had a decent year. And I remember I'm sitting home, living in New York City, struggling, rents are high, all like any other young 22-year-old would be thinking. And I remember getting this box in the mail. And it was a little white box. I think it came like, I don't know if it was FedEx or it was in the mail, but it was a really cool looking box. It happened to be from Paul Tudor Jones. And I opened up the box and it said, "Congratulations. Paul's making a donation in your name to his new charity that he's starting, known as the Robin Hood Foundation." So here I am, I'm 22, and I'm like, are you kidding me? Like, I need the money. I needed that money. Looking back, obviously, it's the greatest charity in the world, unbelievable charity. And, but it's just funny because some things have a way, some things when you look back, like they become major milestones. And for me, needing more money for me became a major milestone. And that box, literally, when I got that after that, I literally really, really thought about trading off floor. And I had a friend that was literally begging me every single day to come and join him. And he was working on the American Stock Exchange and trading stock options. And after that, I actually left and joined him on the American Stock Exchange, where we ran a huge group. And I know that you had one of the Blair Hull traders on that I think was doing it in the P Coast. And but the American Stock Exchange, and I don't know if you want to talk about that, was a little bit different than the P Coast, but very, very interesting nonetheless. And for the next 5 or 6 years, I ended up trading on the American Stock Exchange and running the largest group down there at the time.
Okay. And what exactly were you trading on the floor there?
So we ended up having guys that were trading literally we would put people in every single market, trading equity options, and completely different exchange. So it was the first time I was actually on a floor on an exchange. And the way it was set up was really interesting because you didn't have to think at all. The specialists would do all the thinking, and they were required to basically give 40 to 60% of any trade that came in out to the crowd that was helping to assist the specialist. So the guys in the ring didn't have to really do anything. They would just be handed trades. And it was interesting because it was very, 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 it was not so competitive, very, very, very easy to make money, not knowing what you're doing. And we had guys making just really ridiculous money, never asking how they're making it or anything. And just because the specialists would be giving them tickets and they would be getting trades that were basically guaranteed winners, if that makes sense, with very, very little risk. So obviously what we did is we went out and hired as many guys as we could, and we put them in all the different markets, all the different equities, and we basically ran a giant book because of that. And they were just down there. Some of them, did question what they were doing and tried to learn. But it's funny because out of the 50 guys that we had working for us, I think maybe one still trading today, which is interesting in of itself. And the rest of them are gone.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So I mentioned before a market wizard who is the second one who will leave unnamed. Was that the trader who you joined on the floor?
No. So after the American Stock Exchange, things started to happen towards the end, and your other trader was talking about it basically on the PCOS, for example. On the old days, the American Stock Exchange had no competition whatsoever. So for a stock like Circus or IBM or Intel that was listed down there, there was no competition. So if somebody wanted to trade an Intel option, they would have to come down and see the specialist on the floor of the American Stock Exchange. The trade would occur, and that was it. What happened a couple years later, and this is the reason why a lot of these traders no longer existed, was all these other exchanges started to trade these same stocks that were traded on the American Stock Exchange. So all of a sudden, where the spreads or the bid and offer was $0.25 wide or $0.50 wide, started to become an eighth wide or a dime wide. And all of a sudden, what was very, very easy no longer was easy. You actually had to start to think about what you were doing and why you were doing it. And that competition literally killed those floors. And the American Stock Exchange was no different. All of a sudden, we had the Boston Exchange, you had the PCOS, you had the CBOE, and all these other exchanges were listing, basically, were breaking up the monopoly that the American Stock Exchange had. And if you didn't really know what you were doing and how you were doing it, you were kind of in a little bit of trouble. And for me, after X years with that, I ended up going over to what was then the New York Board of Trade. And on the New York Board of Trade, I ended up going into, believe it or not, the frozen concentrated orange juice pit. And I don't know if you ever saw the movie Trading Places, but it was very, very similar to that. So I ended up going to a completely different exchange where the rules were completely different than the American Stock Exchange rules. And this is the first time that I would say that there was basically real trading. This was complete open outcry trading. You had to be first, you had to be fast, you had to be the best price. And survival was basically nobody was handing you anything. Survival was no guarantee. You actually had to be able to think, make complicated two-sided markets at times, and completely different puzzle, if that makes sense, than it was on the American Stock Exchange. And you also, Aaron, which is interesting, but you had to be very anticipatory, if that makes sense. You had to think about your position, not necessarily how it exists today, but how it would look tomorrow and a week from tomorrow, and try to figure out the best way to balance that position off. So it ended up being a completely different experience being on that floor.
Just so we don't leave any loose ends, Larry, I definitely want to speak to you about trading orange juice. But your involvement with the second market wizard who we referenced, what was the involvement there? Was that in relation to the frozen orange juice? I mean, just so that we, can tie that off and keep moving. Yeah,
so basically after, the second market wizard comes into play a couple of years later after the floor. Not after the floor, towards the end of the New York Board of Trade. There was like a 3-year period where there was the second market wizard did not yet appear.
Okay.
Sure. That's why. Sorry, that's why I didn't bring that up yet.
Makes sense. So how did you get into trading frozen concentrated orange juice? I mean, it just seems like such a random thing to trade. I mean, I know it's a real commodity, but why is it a tradable commodity? Like, how widely is it actually used?
Well, it's not really widely used. Believe it or not, they use it in the prison population. That's usually what they were using it for. But the market at this time in orange juice was fairly crazy and fairly active. There were a lot of players, and there were some very, very large players, off floor that actually needed the market to hedge. There was no fresh orange juice market at the time, so they were using the frozen to basically hedge their fresh. And for us, it was great because there was tremendous order flow, tremendous things were going on there, and a real theme started to occur. It had occurred for me throughout my entire trading experience, but it really started to become concrete on that floor. And the way I think about it is that, and I always say, when things that should happen do not happen, that is such a big information piece. There's so much noise on the trading floor. When you come onto the trading floor in the old days, there's just so much. It's so chaotic. If I brought you down there or somebody came down there, you wouldn't realize you would just hear noise and screaming. But in that, some of that is very, very valuable information. And I think, and I know I'm getting random here, but I think that you're seeing it like today, where you have so much information and so much different data coming at everybody. It's very similar to the trading floor. It's very, very similar to the trading floor. And the best traders were able to figure out what true information is and what information will be impacted in the market versus what noise is. And too many people get carried away with noise. They'll see something on the tape or this or that versus what true information is. And the true information is what we are seeking to achieve and basically looking to model. And that is literally the biggest key.
So how are you able to differentiate between the two? I mean, I guess that's where it becomes really tricky, is actually differentiating what is noise and what's information or signal.
Yeah, and that really comes from a couple of things. It comes from, and I'm actually I'll give you an example. So we were down in orange juice and we were in the pit, and there were a bunch of order flow started to come into orange juice, and they were buying massive amounts of call options. Basically, they were making a quote unquote bullish bet on the future price of orange juice. And they were doing it in such a big way that the price of orange juice should have been moving up at this time. I think coming into the thing, we might have traded, for example, 1,000 options a day. During this 3-day period, we were trading 5,000 options a day, 6,000 options a day. So it was so extreme, and it was just straight out a call buying. Buy them. And the price of orange juice should have gone up. And all the guys, I don't know, how familiar we want to talk about options, but the guys in the pit, the floor traders that were making markets and selling these calls, had to buy futures to protect themselves. And the call buying was so fast and furious that everybody was raising their implied volatilities to protect themselves, and they were being forced to buy more and more futures. Well, that was all fine and dandy, and my partner made a great point. 2 days later, the futures price did not move at all. Completely didn't move. That bit of information was absolutely critical and huge. And I'll tell you this, a month later, orange juice lost 50% of its value. It absolutely got imploded. And Aaron, I see it today. So take that one little example of something that should have happened that didn't happen. And we see it today. We see it. Sometimes you get exogenous call buying, for example, in a stock. Okay. And we had one a couple weeks in Starbucks. We had it a couple weeks ago. They came in and they're buying massive amounts, abnormal amounts of call buying. Stock price doesn't move up. That's huge information. 2 weeks later, the price of Starbucks goes down pretty big, $6, $7. So it's being able to use huge information and the correct information. And the best information is actual impacted information. So these were people that were coming in and they were buying call options and they were putting their money down. And when things don't happen that should happen, that's when there's real money to be made, when the markets literally go the opposite way. And by the way, if you think about it, look at the election that we just had with Trump. Everybody said the market should be down and down big, and it should have been a bloodbath, etc. And when it wasn't, that's information. So it's basically every single day, it's every trade, asking yourself what should happen and what did happen. And if you start to think along those lines, all of a sudden you start to see what's working, what doesn't work, and you could start to model sort of correctly, as opposed to modeling based on, okay, if a market, for example, closed lower 9 days ago, and and the RSI is above a certain level, we'll buy the market. I mean, that's just back testing stuff, where this is actual market information.
So in these couple examples you gave here, you said that the price should have gone up because there were so many people taking bullish bets and buying options. Why did the price not go up and barely move at all? Why not?
So what most likely happened was that smart money came in to buy those calls because in reality, they wanted to protect themselves. They wanted to short the futures and have, God forbid, protection if they were wrong, where the calls would basically stop them out. And they came in and they probably, for every call they bought, they would sell a future. So the futures were not moving up as they should have. And the Starbucks example was probably the same thing, where they came in and they buy thousands of upside calls. And you know what? The price isn't moving because they're shorting the stock. And they could be shorting the stock for any slew of reasons, but there's a probability that could be smart money, if that makes sense, or insiders or somebody that knows something that's going on. And not all the examples work like that, right? Sometimes they come in, they buy all the calls, and the stock moves up. That's fine. That's what's supposed to happen. So it comes down to when something's happening that should not happen. That's what should pique your interest. and look at it that way. That's where real opportunities to make substantial amounts of money lie. When something doesn't happen and should happen.
And when you're talking about smart money and you're referring to other participants as they, who are you actually talking about in these examples? Like, I know you don't know specifically, but like a general idea, like who are you referring to here?
So like in the case of orange juice, there would be smart money would be considered somebody that's actually producing the orange juice crop, and they actually have oranges. They know, they have better information than anybody. They know, what the demand is. They know how much they're selling, and they know they can look out their window and see, how big their crop is. And orange juice is an interesting example because it's a very, very small market, and there's some people in there. Louis Dreyfus is the biggest player, and they basically control a lot of this crop. You wouldn't know if you're standing on a trading floor, who's, which order's coming in, who it is, but you look for certain patterns and you look for how the market reacts to certain things. And, I know orange juice or the Starbucks example is just two small examples, but it's any way that information or data reacts to the actual impact and the price movement of the underlying and what should happen. There's no way, like you said, there's no way to always be able to tell what the smart money is or the dumb money, but you start to see patterns. And you can start to see when you watch news, for example, or different data, that some of it doesn't move the stock, and other times other information does. When we stood on the floor of the American Stock Exchange, if somebody bothered to pick their head up, there were times when there would be 50 brokers coming in to buy, calls or puts, or come in for a reason to buy a stock. Other days, nobody would be there. And I've always said, and we've always tried to model, well, why are brokers coming in today to buy this stock? And you backtrack. You say, okay, let's figure out why. Was it a technical point that came out in the market? Was it earnings? Was it some news? What was it that is impacting that price? And I say this because I want to say, as opposed to looking back and saying, okay, IBM went up 3 days in a row, so therefore the next day should be down. That kind of model, if that makes sense. The models that we look at here, what I'm doing now, and the models that we've developed deal with actual things that are happening, informational and data in the markets versus what should happen, if that makes sense.
Okay. Yeah, no, it does make sense. It does make sense. So let's say you spot some of this activity, which seems kind of unusual. Mm-hmm. How do you actually plan a trade, and how do you actually trade based on that information? Like, how do you actually capitalize on what you've observed?
Well, in the case of the ones that we just spoke about, so you would we would basically let a little bit of time go by and see what happened. And we know when we model it that, X, Y, and Z should happen. In those two cases, in orange juice and Starbucks, for example, just to use those two and just to use this one form of information, because there's a lot of them out there. Just to use those two, over the next day or so, both of those prices should have moved higher. So orange juice and Starbucks. Both cases did not happen, and actually both started to go down. So that was the tip-off to a trade. Now, how you express that trade, that's really dependent on the risk tolerance that you have, whether you want to go short it, protect yourself with a call, or if you were long, you may be realizing you might want to get out because the probability has now changed in that marketplace. And, how basically you want to do it, you can short it or whatever. That's really up to the individual trader and how they do that. What we do here is we obviously, you have to have a point where, even if you have that information, you have to have a point where you're going to be wrong. And if you're wrong, you have to get out.